all Fed officials will tell you it's about the totality of the data. So it's not just what's happening with the labor market, but what's happening with inflation.
The hope would be, of course, that rate cuts would be forthcoming.
The Fed's not going to move at the end of this month, but September is live.
I think what will cement September is really another round of data.
At the end of the day, what's going to drive the Fed in the next 3 months to September is inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your week started live from New York City this morning. Good morning for our audience worldwide. Coming off the back of the best week since April on the S&P 500. Coming into Monday at all-time highs. There is something for everybody this week. A double dose of Chairman Powell coming up a little bit later. CPI later on in the week. Q2 earnings kicking off with JP Morgan as well. We have to begin with another upgrade to the S&P 500. This time from a good friend of this program, John Stolfus. Over at Opco, the new numbers, 5,900 from 5,500, the second most bullish on the street right now. The line, Lisa, from Opco, the bull market has legs.
Given the fact that we've seen this sort of multi-cylinder aspect of the rally, and we've seen that over the past couple of weeks, this is the first time that we've seen in history, at least 2015, we haven't seen all of the Magnificent Seven names being down on the same day. This has been built up by fundamentals and many different names pulling their weight.
We're bored by all-time highs,
yes,
aren't we? The drama has been in the politics, the political world, down in Washington, D.C. The pressure building on President Biden. There are more and more House Democrats lining up, calling for him, Anne-Marie, to step aside.
That's right. Whether it's publicly or reported by Bloomberg, coming out of this meeting yesterday with Minority Leader Hakeem Jeffries, 9 Democrats we know at this moment are calling for the president to step aside and pass the torch to a new generation. Now, lawmakers are coming back to Washington, D.C. today. Between the Senate and the House, there's going to be meetings, especially tomorrow on Tuesday. Does that number grow? And look at what Senator Chris Murphy said over the weekend. This is a very critical week for Biden. Not only is he going to be hosting world leaders, he's giving a press conference on Thursday. And it's not really what he says at the press conference. It's how he says it. It's can he formulate sentences together, how he looks. All of this is going to be scrutinized to the highest degree.
Here's what I love. Stuart Kaiser, who's coming up later in the program, put it really well. He said near term, it's inflation data on the start of earnings, where you started. Medium term, it's the political drama that you're talking about when we talk about potential risk, as well as, of course, the fact that jobs and inflation, question of how much they're actually going to work to the Fed's favor. But this is the issue. People don't know how to even play this. I don't understand whether, basically the idea of a Trump trade was the same one that we saw back in 2016, but it reversed as soon as people really gathered what would happen.
Before we even get into market consequences, there is a very subtle but very important disconnect between House Democrats and the country. House Democrats are freaking out about their prospects of winning in November. The rest of the country is talking about the next 4.5 years. I think that's a really important disconnect right now, because this has been a conversation in the general public and the electorate now for the best part of 3 years. We've been talking about this for a while. It's been in the polls for a long time too. It's only in the last couple of weeks that House Democrats have started to freak out about their prospects of winning in November.
Well, the debate opened the doors for people to vocalize potentially some of these concerns and consternation they had behind closed scenes. What we've seen in the polls for the better part of a year, that Americans have been concerned about his age. But the debate performance was so concerning and so disastrous for Biden that Democrats are now coming out. And the ones that we know of, a lot of them, after this weekend's call with Hakeem Jeffries, a lot of those individuals are top of the rank when it comes to committees. Wait till the ones that are in serious hardcore elections in November and they are at risk of losing their seats. The calls are just going to grow.
Peter Baker of the New York Times put it really well when he said the conspiracy of silence was broken. This among Democrats. It was a silence among elected officials and a lot of media members. It was not silence among some of the voters who had already been indicating their concern about this.
More on this conversation in just a moment. I want to talk about what's happening on the other side of the Atlantic and focus on politics out of France. Let's bring up the board and look at the euro. The euro's doing nothing at 108.36. French bond yields are higher by a couple of basis points at 3.23. If you came into all of this worried about France's fiscal trajectory, if you came into the weekend worried about France's ability to govern itself, I think you come out of the weekend, regardless of the results, Lisa, still worried about what's happening in France.
Here's my ultimate question. Is political gridlock a good thing? Is it a good thing for markets? Is it a good thing for government? In French markets, it's less clear, I think, than U.S. markets, where it's clearly something that is welcomed by governments. But what we saw from Frederic Ducazet of Pictet Wealth Management, he came out and said, basically, chronic instability may require the president to resign. And this is the fear that a lot of people have at a time where they need to make some real budget decisions.
When it comes to also what the left is calling for, you have UBS, Paul Donovan, saying this is basically two Liz Trusses, 4% of GDP of what they want to spend. But the fact that they haven't got all the seats, there's going to have to be a coalition or gridlock, a hung parliament. This basically says to the financial markets, status quo.
That's Europe. Let's get to the scores more broadly. On the S&P 500, equity futures not doing much at all, just about unchanged. Positive every single trading day last week. A really stellar week of gains on the S&P and on the Nasdaq. Not so much on a Russell. We'll be talking about that a little bit later. Yields are higher by 3 basis points. The 10-year 430.96. And in foreign exchange, as I mentioned, the euro 108.36. Coming up this hour, here's the lineup for you. Terry Haines of Pangea Policy on the growing number of voices calling on Biden to bow out. Geoffrey Yu of BNY Mellon with traders raising bets for the Fed to start cutting rates in September. And Nela Richardson of ADP with a busy week of data on deck. Bramo, the week coming up, not just the data, but Chairman Powell twice and the earnings kicking off on Friday.
So what I feel like is that there's sort of this competing discussion right now about which is it? Is it immaculate disinflation or is it the winds of stagflation? And this is really going to be in cold relief this week. We have economic data front and center. We have CPI and jobless claims on Thursday, PPI and University of Michigan sentiment survey on Friday. Before that, as you were mentioning, John, policy very much in the front and center with testimony on Capitol Hill from Fed Chair Jay Powell, 2 days of that. Treasury Secretary Janet Yellen is also going to be speaking amid those swirling rumors about the Biden race and kind of whether he's going to drop out amid the NATO meetings. And then, of course, the start of Q2 earnings. We haven't even talked about this. We get JP Morgan, we get Citigroup, we get Wells Fargo on Friday, we get Delta before that on Thursday. And I really think this is going to really raise the question of their outlook, their visibility into the future.
I was going to say something really serious about the week ahead, and then you mentioned Delta. Terminal 4 at JFK.
Yeah, I know.
It's got worse.
Terrible. I know.
You have to get a shuttle to get the cabs now.
All right, okay. Anything else?
Yeah, 10, 15 minutes sitting there on a shuttle to go and get a neighbour from a car park
Have
somewhere.
you seen LaGuardia? It is beautiful. It is finally a first world airport. And that's what JFK wants to get to. And the problem is it just takes more effort when you have infrastructure already built.
That's the price you have to pay.
Correct.
OK. It really made me laugh coming out of Terminal 4. So you're coming out of JFK and working your way back into Manhattan.
It's horrible.
The traffic's really backed up. It's terrible. And you can see the roadworks on the side. And there's a sign there saying that this is a consequence of the bipartisan Infrastructure Act. And you're thinking, I'm not sure that's good promotion for Washington, D.C. at all.
Thank you. Aces.
Thank you so much for that. Let's begin with our top story. The pressure mounting on President Joe Biden to end his re-election bid. According to people familiar with the discussion, several top Democratic lawmakers are privately joining the calls for Biden to step out of the race. Another 5 House Democrats have gone public. Terry Haines of Pangea Policy is writing this. Biden's given a middle finger to a Democratic political and donor class that's always viewed Biden as their creation that they can cast off at will. He just reminded them it's not that simple when you're both the president and the nominee. Terry joins us now for more. Terry, wonderful to catch up with you, sir. In about an hour from now, we'll catch up with Henrietta Treyz, someone you know from Veda Partners, who's saying this, that 70% odds on Biden stepping aside in the days ahead. Terry, you take a very different perspective on this. What's behind that view?
I don't see the pressure on the president, frankly, and much more importantly, the president doesn't see the pressure. You know, the ballyhoo over the weekend is a bunch of mid-bench Democratic lawmakers, no offense to any of them, and a supposedly brewing insurgency by Mark Warner. What these things have in common is that they are nods to the Democratic institutional, political, and donor class, who 2 weeks ago were heading up the Peter Baker conspiracy of silence that you all referenced, and today are screaming to get out. And, you know, plus that, you know, you make a very good point, John, that, you know, largely what this is about whether he can win, not whether he's still fit to be president. And that tells you an awful lot about the motivations here.
But Terry, this list of individuals is likely growing to call. We have lawmakers coming back to Washington today. What's the threshold for the Biden team to hang on?
Well, you know, I think it's very simple. You know, the weekend press was full of stories and visions or videos showing the congressional delegation going down to basically tell Nixon he was through in 1974. You look at who those people were. They were the Republican leader in the House, a former presidential nominee of the party, among other things, and a very senior senator. A bunch of mid-bench Democrats doesn't get that done. A bunch of folks in the Senate doesn't get that done. And, what I think the White House is looking at, frankly, is look, we're here. He's fine. We can walk through the next week and show that he's fine. And then what's going to happen is that the press and a lot of people are going to see this fizzle a little bit, and the press will turn its attention to the Republican convention. I bet that's what's going on here.
But Terry, Biden over the weekend accidentally said he's the first black woman to serve in the White House. There are going to be more moments like this. What is the next event that you foresee, potentially like the debate, that can open up the floodgates even more to mount pressure on this president to step aside? Well,
you all well know I'm not a Biden apologist here, but and one other thing I wrote, I think Friday night after the Stephanopoulos interview, is that this isn't baseball. Biden doesn't have 2 more strikes; he has 1 more strike, and he's got to prove every day from now until the election that he's up to this. Because if there's 1 more slip of the kind that he had in that debate, I think he's basically through. I think the floodgates open for the Democrats if that happens. But absent that, I don't think it's going to happen. And frankly, I think what you're seeing from Biden is disdain towards the Democratic political and donor class that helped him until last week, and now decide they want him out. The White House isn't buying it. Biden personally isn't buying it.
So basically, is this the conspiracy of silence waking up, and everybody else already has been in this game, including the voters, and this doesn't really change anything? Or has this been a market change where essentially, as things are going, given that time is running out for Biden to step aside, Donald Trump will likely win?
Oh, I don't think that's the case at all. It's one other thing I push back at. There's a great overbelief in the Democratic establishment among those who think that Biden's going to resign soon. I mean, the Almighty has to tell him. So, and none of those people are the Almighty. The other thing is that they're looking at the wrong polls, frankly. The polls, including Bloomberg's own poll yesterday, show the race still at a dead heat in the Electoral College, which is the only place it matters, with still about 77 Electoral College votes up for grabs. And Biden's got 4 months to try to convince those people. And the Democratic Party is going to do that by, frankly, turning itself more into an institutional party of the kind, and you heard this on the Sunday shows, where, we're for all the right things that you like, social issues, economic issues, we're for all the things that you want, and we're going to go convince you, independent voters, that we're worthy of your vote, and regardless of who the president is, and we're going to scare you even more about Trump.
Terry, great to catch up to get your view. Terry Haines there of Pangea Policy on the growing gap between what the president thinks is good for the party and what the party thinks is good for the president. We'll have a very different view on all of this in about 1 hour from now. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Protesters rallied in Israel on Sunday, marking 9 months since the war in Gaza started. They're calling for Prime Minister Benjamin Netanyahu to step down and for a ceasefire to bring back hostages still held by Hamas. Truce talks did advance last week after reports that Hamas has broadly agreed to a U.S. proposed ceasefire plan. Now, France could see a political gridlock after a surprise win by a left-wing coalition in the country's parliamentary elections. The new Popular Front won the most votes in Sunday's vote, but it was about 100 short of a majority. President Emmanuel Macron's group came in second and the far-right National Rally in third. Now the focus turns to what sort of coalition is built and how Macron makes nice with a party that wants to undo many of his reforms. Hurricane Beryl made landfall in Texas earlier this morning. Forecasters warned that winds could drive as much as 7 feet of water onto parts of the coast. Officials told residents to take precautions and oil companies to adjust operations. The storm already caused severe damage in Mexico and across the Caribbean. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, September in the crosshairs.
I think this keeps September on the table. As long as we're seeing trends towards a slowdown in top line, the unemployment rate, broader measures of labor markets normalizing, I think that'll be enough.
That conversation just around the corner. Looking ahead to this week, looking back at last week. From New York City this morning, good morning.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest premieres Monday at 9 a.m. Eastern, only on Bloomberg Television.
From a steamy New York City, welcome back. Equity futures going absolutely nowhere on the S&P 500. We are unchanged, and the bond market yield higher by 2 or 3 basis points, 430.76. Crude a little bit lower. We're down 1 full percentage point at $82 and about 15 cents. Under surveillance this morning, September in the crosshairs.
I think this keeps September on the table. What will cement September is really, another round of data and more importantly, what we see in terms of the inflation data next week and what we see next month. I think that's going to be the case. As long as we're seeing trends towards a slowdown in top line, the unemployment rate, broader measures of labor markets normalizing, I think that'll be enough. Not enough to say that today, but I think once we get to September, that'll be there.
So here's the latest this morning. Traders reviving bets for a September Fed rate cut after Friday's payrolls report. Investors looking for further clues with a double dose of Fed Chair Jay Powell on Capitol Hill this week, plus US CPI on Thursday. Geoffrey Yu of BNY writing this: the potential for sharply weaker third quarter growth makes this a summer of discontent with recession risk rising. We are expecting a September rate cut as we think inflation will behave better over the next few months. Jeff, I'm pleased to say, is with us now. So, Jeff, let's put it together. Lots of people back from the beach after a long weekend here stateside, looking back at payrolls on Friday, but also the ISM right before July 4th. Tremendously weak, Jeff. When you look at the so-called totality of the economic data, do you think there's reason to worry?
I wouldn't say it's reason to worry yet, but the direction of travel is clear. There's a difference between an outright recession, which would need to prompt much more aggressive central bank intervention anywhere, versus the slow grind, towards normalization or a normal environment, that we're used to during previous cycles. I think it's more of the latter right now. But the Fed, like most central banks globally, have said they don't need to wait for inflation to seriously undershoot targets before acting. So I think that's where we are right now. And markets are pricing in on course for a September move.
Jeff, you can feel the tension in the bond market further out along the curve. You've got the prospect of a decelerating economy colliding with an election decision that might produce a president with a more, let's just say, a more higher inclination for a set of policies that could deliver more inflation further down the road. I think what we've got to decide here, Jeff, is should I be buying the 10-year or selling it based on what could happen in the next 6 months?
Well, I think a steeper curve is, pretty much, nailed on at this point. But the back end, what exactly the reasons are behind it. Here's where we need to dissect things a bit. I think Europe is, providing a bit of the guidelines, right now. Markets are going to start extracting a fiscal premium, right? So, yes, front end lower. That is reflationary. That helps steepen curves as well. But if you're going to add a dose of fiscal, which could have, questionable, funding, so to speak, which again is what we're talking about in Europe, right now, then I think that's a different story. So again, steeper curve, but in a gradual, normalized, steady manner, or is it going to be something less so? I think that's what markets need to watch out for.
Is political gridlock really the best case scenario? And I'm talking about the U.S., but also France, for example.
Well, I would say perhaps it's the least worst scenario. That seems to be the market interpretation out of France. You have one side, where pushing for very aggressive, spending views. That's probably not going to happen. But on the other, if I look at Germany, for example, they've managed to resolve their own budget gridlock. And the economy minister talking about increase in 0.5% in terms of the growth rates. So this is mildly reflationary for Europe. Alas, it goes against my euro-dollar lower view. But I think caution in terms of pushing forward the fiscal narrative is important. important. So from the US's point of view, if nothing too aggressive gets done, then I think that's something bond markets will be willing to accept. But I think we'll cross that bridge when we get there.
Jeff, John was talking about this tension with respect to long-term bond yields, with respect to the fiscal policies that potentially to come down the pike versus growth concerns. I want to talk about the growth concerns aspect. Given some of the jobs numbers, given the unemployment rate rising to 4.1%, given ISM services coming in so far below expectations, where are we in this uncomfortable balance between disinflation and slowing growth?
Right. So from a central bank's point of view, they would like to see disinflation, gradual slowing growth. But on the political side and on the fiscal side, the worry is when politicians see slower growth and they see lower jobs numbers, the impulse, the reflexive reaction almost is to get some fiscal injection to boost demand and to get growth going again. I think that's what could spook markets further down the line. We've seen what's happened in Europe already, in France. But on the other hand, the US has that reserve status. International reserve managers will continue to buy the dollar. They may like US 10-year yields at 4.5%, 5%, that kind of a range. So maybe the US can push that narrative, the fiscally driven growth narrative, a bit further. But how far are we going to test it? You only find that point of no return until after you've crossed it. So I think that's where we need to be a bit more cautious.
Jeff, when I look at your note, you say there's plenty of reasons to worry about both the dollar and the euro. Both have their sets of problems. When you look at the wall of worries on both these currencies, which one worries you more?
Well, in the short term, it clearly still is the euro, because if we look at manufacturing in the US versus manufacturing in Europe, all the surveys, ISM versus the PMIs, nothing to be inspired about there. But the value-added components for Europe, that's coming from manufacturing, and there's just no outlet right now. The ECB can't adopt any stimulus, whereby the US still has the services economy to push forward, and also the dollar can rely on the reserve angles. So, alas, even though the US is expected to have the worst fiscal outlook in terms of the G7 nations, it's still Europe in the short term and over the medium term on a structural basis that I do worry about more.
Jeff, before you go, we've got to ask you about this analysis coming out of Goldman Sachs, led by Jan Hatzius, over at Sintra Portugal last week. Just assuming what could happen here with proposals coming out of a Trump presidency, could raise the average US tariff rate by 16 percentage points to nearly 20%. They plug that into what you could expect for monetary policy, and this is what they had to say. Net implication, hawkish, to the tune of 130 basis points, because the large hawkish inflation effect clearly outweighs the smaller dovish growth effect. Jeff, how are you and the team at BNY thinking about the same thing?
Well, also tariffs would be imposing effectively real effective exchange rate appreciation potentially on other currencies as well. So will there be a disinflationary impact about the dollar? We've talked about benign neglect for decades in terms of the dollar, but given where valuations are right now and you impose additional potential reflation in that sense, then will the initial strength in the dollar brought about by tariffs, will that start to import disinflation as well? I think there are quite a few dynamics there, but I do agree the initial path probably is to look towards an inflationary outlook for the US. So it's not going to look great for the Fed. That's something that they want to push back against, perhaps behind the scenes. Amazing. Jeff, thank you, sir. Geoffrey Yu there of BNY out of London, out of New York around this table a little bit later this morning. Adam Posen, 7:30 Eastern time. Don't miss this conversation. Lisa, him and a team at the Peterson Institute doing a ton of work about what changes to immigration policy could mean, changes to trade policy could mean for this Federal Reserve, and the expectation that maybe this Fed is hiking, not cutting, in 25.
And that might be even the next move, considering some of these risks that they put on the table. This we've heard from other people, too, that the Fed could be posed to hike rates, not just once, but 6 times, because it's essentially the equivalent inflationary hit from some of these policies. This is the question. When you hear from Fed officials is we're not political, we're going to just deal with the economy as we have it. Interesting to hear what they're really pushing back behind the scenes.
Yeah, they've got to deal with the policy right in front of them.
Yeah.
But this gets complicated, particularly going into September, where the data's lining up for that first interest rate cut from this Fed.
They don't want to be accused of what happened in the 1970s. And that, I think, is looming over them, even as the data points in their direction. In fact, with an extra dose of growth worry, I would say, even more than many people had expected.
Adam Posen joining us in about 60 minutes' time. Up next on the programme, we'll catch up with Nela Richardson of ADP, looking ahead to a busy week of economic data, including CPI on Thursday. From New York City this morning, good morning. Your equity market just about unchanged. Let's get you up to speed on some of the scores this morning, and good morning to you all just tuning in. Welcome to the programme. Your equity market on the S&P 500 totally unchanged. Similar move on the Nasdaq, just about positive on the Russell. The scores last week, though, Lisa, indicative of some of the concerns people have got about the broader market. The S&P 500 up something like 2%, best week since April. Nasdaq up by something like 3.6. The Russell down on the week.
Because what you had right now is the idea that any kind of rate cuts are going to come with weakness. And you could really look beneath the hood. Take example, the jobs number that we got on Friday. On the surface, it beat expectations, yay. But then there was this downward revision of 111,000 jobs to the previous month, boo. And then you have the unemployment rate going up to 4.1%, somber roll. So these are some of the concerns that are kind of the crosswinds under the current.
What did Chairman Powell used to talk about? Cross currents?
Yeah.
Not crosswinds under the current, or crosswinds under the current?
Okay. Oh,
is that what he said or what you said?
I'm sure I said it wrong.
Okay.
I'm sorry. It is Monday after a long weekend. I'm going to have a lot of incorrect expressions.
Crosswinds under the current. Now I'm confused. I don't know what I said anymore. Let's get to the other board, the bond market. Let's talk about the crosswinds under the current in fixed income.
Please.
I've got no idea which one's right. Okay, let's get to the 10-year. Just pick out one, because we can only handle one this morning. Never mind three. One maturity, the 10-year. 4.30 is the yield. So last Monday we closed at about 4.46. Think about why we sold off. A lot of people thought we sold off on the politics, and then it got bought. It got bought on the weaker data. They're the crosswinds under the current in fixed income at the moment.
You said you were not going to say it again, and yet it's so tempting. Next, you're going to say I'm going to beat the dead horse with a drum, which is something that I've also said before. Anyway, let's just move on. By the way, on Wednesday, we've got a $39 billion of 10-year auctions, which 10-year notes being auctioned off, which I think will be interesting. You're right. There is this feeling, and you have to think about an investor. If they're going out, they want safety. Do they go into a 10-year yield in some of the projections of what the deficit could look like and what inflation could look like under different administrations? Or do you say, let's just stay with the 5-year, stay with the 2-year, park it in cash? And that's what you have seen for a lot of this year. There was a shift. And this, I think, comes from real growth concerns, especially with the Atlanta GDP now coming down so significantly, but also that unemployment rate. And I think that we need to dig a little bit further into exactly why it rose and whether it is worrisome.
Two things. One, I love that AMH is hanging us out to dry and not saying anything. Two, the bias in fixed income right now, Geoffrey Yu, BNY, steeper curves. Just steeper curves. Ultimately, the long end's going to rise more than the 2-year at the moment.
Well, and it could be for either reason. It could be because the Fed cuts rates more aggressively because of either growth concerns or because of just general disinflation, or it could be because you get a sticky inflation, a sticky Fed, but longer term concerns about the fiscal trajectory. Either way, a steepener, that's what he could commit to.
It's one of the worst market checks we've ever done. It'll be me doing an interview with ABC's George Stephanopoulos soon, trying to sort of make up for it and stay on the programme. Let's get to the euro.
Thank you. You're welcome.
Too soon?
Yeah, that was great.
Let's finish on the euro. Euro right now, 108.36. Let's get away from this. Under surveillance this morning, our top stories, at least 9 Democratic lawmakers are calling on President Joe Biden to end his campaign. Bloomberg reporting Democratic Senator Mark Warner will not hold a previously discussed meeting today to discuss Biden's bid. Talks will continue during a regularly scheduled caucus tomorrow. Congress is back. Is there anything else to talk about?
Congress is back, and cross currents you see in Washington, D.C. is the fact that you have those that are sticking by the president and others who are saying he needs to step aside and resign. Just on this program, Terry Haines still thinks Biden's going to be on the ballot. And he says it's 50-50. He agrees with the president when the president on Friday said it's a coin toss, basically, this election. But then you have Greg Valliere and Henrietta Treyz, who's going to be on a little bit later in the program, saying their base case is that Biden does step aside. The pressure becomes too palatable for the Biden camp to remain on this ticket.
By the way, I saw you Googling cross currents, so well done. I will just say, I do think that this is really ultimately going to come down to what is the political liability of the uncertainty over who replaces President Biden on the ticket versus this real fear that he could be a political liability to their races. A real sort of difficult moment for a lot of down ballot politicians.
But at the moment, some of the names that are coming out, at least that Bloomberg has reported after this Hakeem Jeffries call yesterday, are individuals who are in secure positions in the party on committees and also within their districts. So wait till the voices come back of those that have really, really tough races. And they're saying, ooh, the top of this ticket is not looking good for my race in my district.
I'm looking forward to the conversation with Henrietta Treyz in about 40 minutes' time. She thinks there is a really big chance that in the next couple of weeks, maybe next couple of days, that Biden has to step aside. So we'll get that opinion for you a little bit later. Let's get you the latest on France. Heading into political gridlock after a surprise showing from the left, the new Popular Front will not capture enough seats to form a government. But French President Emmanuel Macron's Centre Alliance fends off another challenge from Marine Le Pen and the right. So put it all together, Lisa, ultimately in the bond market, politically agnostic, of course, you're facing a prospect of a France that can't govern itself, can't do things about what most people assume is an unsustainable fiscal trajectory. And ultimately, the problems in the bond market don't go away anytime soon.
So I spent time over this weekend trying to understand the French political governing system, because gridlock is very different over there than it is in the United States, where it's a positive thing. Over there, it just could render the president completely toothless, unable to govern, which creates a real problem at a time where the fiscal overhang is pretty significant. So you're right, it doesn't do anything. And right now, bond markets aren't responding because they don't know. Right now, it's sort of a clock that's ticking. And the crisis continues with this question of exactly who's going to rule and whether they can come to some kind of coalition.
And it can take a very long time to get this coalition together. I have to say, this was, and Jonathan, you mentioned this earlier, this really wasn't about French voters going out and voting for a party. They coalesced and voted against something. And I find that very interesting, because the first round of the election, Marine Le Pen's party did very well. And then when you had the coalition come together, Macron's party and the left say, we're going to pull some candidates to try to make sure we can fend off the right, that's when the left did better. It's very hard to understand where politics is going in France. And Marine Le Pen came out and said, actually, sure, we didn't win, but the tide is rising.
I'd extend that to a lot of Europe. I think there's similarities between what happened in the UK last week and what happened with France over the weekend. The electorate voted against something. In the UK, voted against Conservative leadership of the last 14 years. In France, voting against the right and Marine Le Pen, coming together to do that. The consequences, though, so different that you end up with a massive majority for Starmer in the UK and you end up with gridlock in France.
I'm jealous of the UK. No drama, Starmer. Dull confidence. Oh, I would love dull confidence.
You hope. You hope that's what we get.
That's what people say.
Yeah, okay.
Just wait. This is a government that at one point was trying to figure out if the prime minister would last as long as a head of lettuce.
I'm saying something positive about politics. Just let me.
Good effort. All right. Bit of tension between you two. Busy week ahead. Fed Chair Jay Powell heads to Capitol Hill on Tuesday and Wednesday before another round of jobless claims, plus US CPI on Thursday. A lot to look forward to, a lot to look back on as well after payrolls last week and a really soft ISM services read. With us around the table is Nela Richardson of ADP and a Bloomberg TV contributor. Nela, good morning to you. Good to see you.
Good morning. Good to be here.
Great to catch up. I think we've got to start with last week before we talk about this week. What's your takeaway from payrolls on Friday?
Well, it's obvious. There's two. The labor market is cooling and it's becoming more concentrated. If you look at the sectors that were driving that hiring, that 206,000 top line number, government and healthcare, 70%, more than 70% of the hiring was done from two sectors. If you peel back just to the private sector, only 136,000 private sector jobs were actually created last month. That is a concentrated deceleration of hiring, and it's concerning.
Favourite question of ours, welcome cooling or unwelcome deterioration? It sounds like you're the latter and not the former.
What was that again?
Welcome cooling or unwelcome deterioration?
Welcome
Which one
cooling
is it?
Or unwelcome deterioration? I think it's an unwelcome deterioration. If it was a broad-based hiring, if you were seeing a slowdown that was consistent, but still hiring in key sectors like manufacturing, especially interest rate sensitive sectors, or sectors that really affect shelter costs in the CPI, like construction, I'm all for it. But what you're seeing is pockets of weakness, and that weakness could actually be problematic for inflation, not a coolant for inflation. That's what we have to really be careful of, because wages are in the driver's seat in the Fed's decision this month and for future months.
So that raises this question. Are you seeing wages fall more than you're seeing some of the labor market data suggest?
Are wages falling fast enough is the key question, and we're not seeing it fall fast enough to be consistent with the 2% target. Look, we look at wages all the time at ADP. In fact, I just looked at 22 million over the weekend while I was barbecuing, and what we found is that wages are different. The complexion is different. It used to be low-wage workers were seeing the highest pay gains. That is not true anymore. High earners are seeing the highest wage gains. And that has an effect on the overall composition of wage growth. And that's the effect that the Fed is paying very close attention to. It's not top-line numbers anymore. That's too easy. You have to peel back Now I'm going to mix my metaphors a little bit. Peel back the hood? No, peel back the onion.
Don't worry, you're talking to the wrong person.
Yeah, you're going to have to do something underneath the top line number to get to the meat of what's going on in this labor market. And it's a wage picture that is much more complex now than it was before in the pandemic time.
And that frankly explains why you're seeing ongoing strength in airlines and in all of the hotels, et cetera, because wealthier individuals can keep spending and they're getting raises, even though you're seeing real weakness at some of the smaller businesses. So when you start to take a look at the overall picture, does this suggest that the economy is stronger or weaker than the Fed currently seems to be making out?
There are key pockets of weakness. This is a lopsided economy. You have some industries really driving the economy forward, but then some stepping back, like consumer durables. I look at that very closely. These big ticket items that are, losing some steam in terms of the consumer's ability to keep up. And then you look at the housing market, which is basically plateauing right now. It's stalled, it's frozen, it's really starved of inventory, it's locked up by interest rates. The housing market isn't doing what it does traditionally during a Fed hiking or cutting cycle, which is translate to Main Street. And that's going to be a big differentiator of what the Fed can do going forward, even as it, I don't say cut, trims interest rates, because wages and the pace of wage growth will keep the Fed from doing steady cuts like the market expects. I think it's going to trim here and there and see how the economy plays out.
That brings us to on Thursday when we get CPI. A lot of people are going to be looking more specifically at OER, owner's equivalent rent, than anything else, because they're looking for some cooling there that could really indicate the Fed has an open door in September, like a lot of people were saying, to cater to the pockets of weakness despite some of the strength that you're talking about. Do you agree? Do you think that we're going to see real housing disinflation in this number and going forward?
No, because housing's problems aren't cyclical, they're structural. Look, the interest rates are not high enough to keep people from buying houses. What's keeping people from buying is too low inventory, not too high interest rates. And that's going to continue. That's trickling down to all of shelter costs. And I've always disagreed with this notion that shelter costs would be the game changer for the CPI in the second half of, it used to be second half of 2023, then it was moved to second half of 2024. It's off the table. Housing is not going to be the savior of CPI. It has to come from somewhere else.
Do you see supply, though, coming back online in the housing market if the Fed were to cut interest rates?
No, because it's unfortunately not just interest rates. We had very low interest rates for a very long time, and still we didn't have enough affordable housing to go around. So it's regulation, it's local politics, not just national politics that are affecting the housing market right now.
You also have data on promotions. What are you seeing in terms of internally peeling back the onion under the hood of how management is promoting individuals?
They're not promoting as fast as they did last year. That's the punchline. And so what you're seeing in the labor market is one that's kind of stalling out a little bit. People aren't leaving, even if they're unhappy. We also have an article out on our website that young people would rather be unemployed than unhappy, but they're still not quitting their jobs. They say they'd rather be unemployed, but they're not actually leaving. So there is some stall out in the labor market. People are not getting promoted as much. They're staying in their chair longer, and you're missing that dynamism that keeps the labor market moving, progressing, hiring, and increasing wages and profits.
I love that young people think that's a choice, that you could be unemployed without a job, without money, and be happy, Bramo.
Well,
thoughts?
I love that they're realizing that that is not possible, which is why they're staying in the jobs and just miserably quiet quitting, which explains why a lot of people have a lot of opinions about new entrants to the workforce that I think might in certain cases be unjustified, but I've been hearing a lot about this from different business owners.
I know you've got opinions too. Nela, it's great to see you. Thanks for doing this.
Thanks for having me.
Great to catch up. Thank you. Nela Richardson there of ADP. More of Bramo's thoughts a little bit later.
It's okay. I think
Let's
I'm
get
done.
you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Indian Prime Minister Narendra Modi will visit Russia today for the first time in 5 years. He's set to meet with President Vladimir Putin during the visit. Russia is India's biggest supplier of weapons and oil. However, Moscow has been deepening its ties with China, which has seen its relationship with India stuck at a low point. Thousands of workers at Samsung Electronics walked off the job today, staging a rally demanding better pay. It's the biggest organized labor action in the South Korean company's half-century history. Negotiations over pay and vacation time collapsed last month. Union leaders say the strike is intended to drive home employee demands by disrupting production at one of the company's most advanced chip facilities. Boeing will plead guilty to criminal conspiracy in connection with 2 fatal crashes of its 737 MAX jets. The Justice Department had concluded the plane maker failed to adhere to an earlier settlement. Under this agreement, Boeing faces a criminal fine of up to $487 million. The company will also install a corporate monitor. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on the programme, a surprise out of left field.
I think the market is probably trying to digest what was the surprise of last night, which is that the left alliance did better than expected and came out first.
The latest on the French election up next from New York City. This is Bloomberg. Stocks just about unchanged here. Futures going nowhere. In the bond market, yields creeping just a little bit higher. Down by double digits last week. Weaker data. Much more on that in a moment. We're up 2 basis points this morning. 430.18. Under surveillance this morning, a surprise out of left field.
I think the market is probably trying to digest what was the surprise of last night, which is that the left alliance did better than expected and came out first. What remains, I think, the main message of last night is that there is not going to be an outright majority for anyone. Obviously, it's an issue because it means it's going to be very, very complicated to find a sense of direction for French policymaking.
So here's the latest following the weekend vote. France is heading into political gridlock after a shock defeat for Marine Le Pen's national rally in Sunday's election. The country's left-wing coalition winning the most seats in parliament but failing to capture a majority. George Saravelos of Deutsche Bank writes this: the divisions undermine Europe's long-term competitiveness and unity. We see euro, dollar and many other dollar pairs staying weak below 110 for the next 2 years. George joins us now for more. George, great to catch up. I know you've got a broader view at Deutsche Bank on the US dollar against other pairs too. I just want to start with the single currency and the weekend's events, and then we'll sort of work our way to that. After the weekend, what does it mean for French policy, for you and the team?
Good to see you, John. I think it's important to contextualize what the market was pricing into this event. If you look at the euro trade weighted, if you look at European equities excluding France, if you look at peripheral spreads, they were all exactly where they were before the first round of the French parliamentary elections were announced. So to me, that's telling me the market was essentially pricing nothing in terms of the spillover of the French events into the rest of Europe. In terms of the outcome we got, it probably will prevent any sort of spillover in that we've got a period of prolonged standstill and political paralysis in France. So I think what it means for the next few months is that nothing's going to happen. The market was already pricing that, which is why the response was so muted. The more interesting question, of course, is what happens on a more medium-term basis on a 1 to 2 year basis. And on that front, we're a bit more pessimistic.
So define a bit more pessimistic, because we saw a number of different notes over the weekend where people basically were saying that it looks like the least bad option right now, but it might be the worst option going forward if there's no political governance. Walk us through kind of what kind of reaction we could see in the euro and peripheral bond spreads in response to this.
So I think it's all about the transmission of what's going on in France to the rest of Europe. We shouldn't be expecting the euro to weaken if it's just OAT Bund spreads widening, for example, if the market is just pricing idiosyncratic French risk. So we think about what does it mean for broader Europe? And I think about the transmission channel by essentially 2 dimensions. The first one is growth. What does this do to growth? And you could say maybe fiscal policy slightly easier. That will be good for growth. I take the more pessimistic view that you've got a situation of prolonged uncertainty, uncertainty with regard to the relationship with Europe. There may well be another election over the next 1 to 2 years. And uncertainty would tend to depress growth. I think we've already seen that to some extent in the PMIs. That has more dovish implications for the ECB. So that's one side of the argument. The second one is what I call how does it impact Europe's capacity to deal with all these strategic challenges Europe's independence, so to speak, versus this new bipolar world between China and the US that's emerging. And unfortunately, it weakens Europe's capacity to respond, because France and Germany were always the locomotives in terms of moving forward. We're expecting, for example, common defense spending to be right on top of the agenda of the new Commission after the European parliamentary election. And with the French government being weak, all of that discussion is going to slow down and effectively make Europe more vulnerable to any sort of external shock that could hit the continent.
You know, as you're talking, I'm thinking the NATO conference is taking place in Washington, D.C. this week. Anne-Marie is going to be covering it extensively. I'm just wondering, this usually isn't a market-moving event. Is it going to be a market-moving event this year, given some of these concerns and the concerns about how European nations are going to fund some of their promises to defense spending?
Well, I think it's not going to be a market-moving event in the most immediate future, but for sure it could be very relevant depending on the outcome of the US election. And I think what we're seeing now in this world of essentially the political center that's shrinking, it's becoming a lot more fluid, and then you're potentially seeing all these different political events become intertwined. I would argue what we've seen in France makes the outcome of the US election even more important for Europe, because Europe's weaker in its capacity to respond. And potentially, if we get President Trump winning a second term, I would argue that would have very important consequences for Europe. You mentioned defense, but even more importantly, trade policy. And this is one point we've been making in our discussions with clients. I think trade policy is much more important as far as the US goes than fiscal policy, where the market would tend to overstate the risks.
George, Deutsche Bank puts parity for the euro dollar as the path if there is a Trump election. How do we get there?
So going back to this discussion of all the different implications of the US election, I would say the most important one by far from an FX market perspective is trade policy. If some of these trade proposals get realized, on the one hand, and this is where all the discussion is focused at the moment, it would have inflationary consequences for the US, potentially more hawkish Fed. But I think the bigger impact will actually be the disinflationary consequences it would have for the rest of the world. Because imagine a situation where the US puts up a huge tariff wall against China goods. All these China goods would have to get diverted into other markets, including Europe. So therefore, we would see a big deflationary shock in Europe, and therefore that Fed ECB asymmetry would become even sharper in terms of relative reaction function. So that's one. And then, of course, it depends on what happens on the tariffs between the US and Europe, which would be almost a direct growth shock to Europe. So for me, trade policy is absolutely the key variable as we're thinking about the US election.
But even if we get another Biden administration, there's still going to be tariffs, and potentially even more when it comes to places like China. So do you see the same trajectory for Eurodollar, whether or not it's Trump or Biden?
So I think that's a statement we hear quite often, that the approach in trade is very similar. I would strongly disagree with that. I think while the direction of travel looks similar, the speed is incredibly different. And if you're looking at what the Biden administration has done over the last few years, yes, it's kept the tariffs. It's imposed marginally higher tariffs as far as China goes. But a potential Republican administration would be talking about an entirely different order of magnitude. And I think this is where it really makes a big difference. And of course, we have a potential situation where we're discussing tariffs on Europe as well, which is something that's not currently on the table as far as the Biden administration goes. So it's all about how big they will be. I think if I can make a last point on fiscal, the market would tend to emphasize differences in fiscal policy. But when you actually do the fiscal scoring between the two different potential administrations, you end up with very similar numbers. And we have to remember, tariff policy is also tax policy. It entails an increase in taxes. So I'm not convinced the big difference between the two outcomes would be on the fiscal side, but would be a lot more on the trade side, and by extension, impact the FX market a lot more than the fixed income market.
I got it. George, this was so well framed. Thank you, sir. George Saravelos there of Deutsche Bank on how trade policy can exacerbate monetary policy divergence. And who's going to eat the Chinese overcapacity if the walls go up here? Europe. Especially given the fact that the U.S. already has basically all but banned electric vehicles. Europe has not. And those walls are very porous and kind of, we want you, but we don't. Don't hate us if we're selling cars in your place. But, you know, don't sell too many. Kind of sitting on the fence over on the continent. Better said. Euro dollar, 108.29. Figure a way to sort of mess up that one. I was actually thinking of that right now. Yeah, I can't. Anyway, all right. Coming up, Stuart Kaiser of Citi, Henrietta Treyz of Veda Partners, Adam Posen of the Peterson Institute, and Collin Martin of Charles Schwab. The second hour of Bloomberg Surveillance up next.
The Fed is somewhat of a cheerleader for the economy.
There's still a broad feeling of uncertainty that's out there with the consumer, so it may not take much for the consumer to pull back.
It really does come back down to the labor market in terms of how much consumers can keep spending.
Everyone is very focused on growth for the Fed, but it's like we kind of dropped the ball that inflation is still kind of the key metric.
If inflation surprises a little bit stronger, they'll hold rates here. If inflation returns to trend, they're excited to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning, good morning. Your equity market slightly negative on the S&P 500 after closing at all-time highs on Friday. I often sit here on a Monday morning and say the week ahead is stacked. The week ahead is stacked. Double dose of Chairman Powell kicking off tomorrow. A second dose of Powell closing on Wednesday, just before you get CPI on Thursday. And I feel like this has crept up on us a little bit here, Lisa. We've got Q2 earnings kicking off on Friday.
I would agree with that. I feel like we're not sort of prepared mentally for this JP Morgan, Citigroup, and Wells Fargo deluge that we get on Friday where we really kick off this understanding. I do sort of take issue with the idea that these are the banks that kick off the earnings season with the tone, because every single time we say this is going to set the tone for the rest of earnings season, and then we always spend that Friday talking about how it no longer sets the tone because it's completely divorced from the other currents that we see under the hood of other places, of smaller businesses.
Got it. Okay, sort of up to speed with where you're going, I think. Chairman Powell setting the tone for this week. So let's talk about Chairman Powell. We often say he's going to get a grilling on Capitol Hill, and then there's not much for grilling. I'm interested in what he thinks about the labour market, the numbers we got on Friday, the ISM we got last week. I'm sure there'll be questions about that. I'm far more interested in how he's going to respond to questions about fiscal policy, whether someone throws in a question there about tariff policy that could come later next year.
He's going to say that all of this obviously relies with lawmakers and the White House, and what the Fed can do is react only after policy is enacted. What can they do about rhetoric that's coming out from either side? Until we just see who is going to be in the White House and what the composition of Congress is, how does the Fed actually enact any sort of policy? Are they having these conversations behind closed doors? I'm sure. Can they come out and talk about it? Absolutely not. Chairman Powell is going to want to look as apolitical as possible this week, especially given all the political drama.
He's got to keep trying. We just had a great conversation with George Saravelos of Deutsche Bank. If you missed it, we'll post that to the webpage a little bit later, and no doubt Lisa will be talking about it in the newsletter as well. How policy out of the White House, tariff policy specifically, can exacerbate monetary policy divergence next year between Europe and the United States. And what he essentially said, if the walls go up here in America, someone's got to eat the Chinese overcapacity. It's likely to be the Europeans. That would be disinflationary for the Europeans, ultimately inflationary for the United States. They're the basic arguments at the moment. So what does that mean? Monetary policy is going to be very different at the Fed compared to the ECB, and euro-dollar is going to face a lot of pressure.
He sees it going to parity. This raises this question about who the tariffs are going to hurt most, whether this is actually going to be a tax in the United States, and to this question of how Jay Powell responds to that. I would just advise a policymaker to ask, how do you deal with the fact that you could see slowing growth while you also see sticky inflation? How do you deal with that? Where do you prioritize inflation, given the fact that that slowdown in the labor market has clearly been a concern for you? And, oh, yeah, by the way, how do you see that playing out this year with what's going on in the current labor versus inflation dynamics?
We've also got to acknowledge how many steps we are down the road. So we've got to confront the one right in front of us. We're talking about who wins November without really knowing who runs and who faces off with each other in November. There's still a question mark over the Biden nomination. We have to talk about it. Ultimately, there is a growing divide between what the president thinks is good for the party and what the party thinks is good for the president.
There's a schism right now in the Democratic Party, and it's the Democratic Party and Team Biden now, and which side of the camp you're going to go on. We are starting Monday with nine congressional Democrats, publicly or reported by Bloomberg, are coming out and saying the president needs to resign. He should not be the nominee for this party. On Friday, given lawmakers are coming back and they're going to having all these behind the scenes conversations, which are likely going to get leaked out to the press, what number does that stand out on Friday? And how does the president perform on Thursday when he gives a press conference. And the press now are almost, as some opinion pieces coming out over the weekend, Wall Street Journal with editorial board today, feel like they've been gaslit and are now out with vengeance against this administration.
All I can say is Thursday, I think, is correct to focus on, because if he doesn't do well at that, what did Terry Haines said? He has 2 strikes. One is already down. Now he's got another one, and that could be it.
I struggle with that because over the weekend, though, the president said in an interview that he was the first black woman to be elected president. Is that not another strike? Are these just going to be gaffes that the American people just accept? But to your point earlier, this has been showing up in polls for months. But that debate really was the window that allowed Democrats to openly come out and say, wow, we have a lot of anxiety and we're concerned.
More on this a little bit later. Equity futures right now on the S&P 500, your scores look like this. Equities closing Friday at record highs. Every single trading day last week, there were 4 of them stateside. We closed in positive territory on the S&P 500. 4-day winning streak coming into this week with yields climbing just a few basis points higher, up 2 basis points on a 10-year at 429.59. Talked lots about the euro. We're just a little bit negative here by 1/10 of 1% at 108.29. Coming up this hour, we'll catch up with Stuart Kaiser of Citi as the S&P 500 powers towards new all-time highs. Henrietta Treyz of Veda Partners as House Democrats call on President Biden to drop out. And Collin Martin of Charles Schwab amid growing bets on a September rate cut. We begin with our top story, the S&P 500 looking past election drama and reaching another record high. Citi's Stuart Kaiser writing this. The 3 themes we are monitoring are 1, corporate taxes via high versus low effective tax rate payers. 2, tariffs through 40 stocks mostly sensitive to tariff-related headlines. And 3, sector exposure, where banks seem to be the most interesting case. Stuart's with us around the table. Stu, good morning to you.
Good morning.
Let's talk about tariff policy. Massive focus. I guess we've got to ask you whether it's too early, too premature to be thinking about these things.
It does feel a little bit early, but, when you move that debate schedule up, I think it forced the market to kind of, gravitate towards these things a little earlier than we would have liked. I mean, look, it's very, if equity markets are talking about politics, it's probably a bad thing, right? It's political risk, not political opportunity in most cases. So I think, this is definitely something that's, obviously, equity markets are performing well, but it's an additional risk factor now that markets need to deal with. On the tariff and tax stuff, I think to Emery's point, you don't even know what Congress is going to look like, so it's a little bit harder to really get a good handle on what that policy might look like. And tariffs are obviously just like a coiled spring, I think, at this point in terms of, you mentioned monetary policy. The question is, how does Powell message that if it happens? Is this just a step function change in inflation and then you're just back to trend, so you don't really want to alter policy to deal with that? Or do they believe it's something that, creates kind of, a risk to the downward trend in inflation that we're seeing and that they do have to kind of remain tighter for longer? So there's a lot of moving parts around that.
After that debate just a couple of Thursdays ago, I think a lot of people reached for the 2016 Trump playbook, dusted it off and had another look at things. How useful do you think that playbook is this time around?
Not very, I would say. Look, it matters. You obviously need to, past performance does, in this case, does actually inform you about where he might go. But I think people would view Trump's policies as fairly fluid, and we're not sure what Congress is going to look like. We're not sure what his cabinet is going to look like. We're not sure what the economic data is going to look like. And clearly he's going to be sensitive to all of those things. So it matters. And I think if you're more bullish on a Trump outcome, you're probably gravitating much more to that deregulatory impulse and how that might kind of impact the banking sector and particularly small cap stocks. If you're more negative, clearly it's the uncertainty and it's the tariff policy that you're kind of balancing out.
When it comes to tariffs, though, it doesn't really matter the composition of Congress. Trump can unilaterally really change the tariff game. But you say fairly fluid. Are you viewing a Trump presidency as the rhetoric now might not be the policy of tomorrow?
I mean, I view both candidates that way, to be completely honest with you. There's a lot of stuff getting put out there. I think, both candidates probably float ideas as well, and they want to see how the market reacts to them. They want to see how policymakers react to them. So, yeah, I mean, I think there's a lot of things that get said at this time in an election cycle that, maybe actually core policies they want to implement. They may be flyers. They may be things that would be nice to have. So I think it's a little hard right now, I think, to gravitate towards anything.
You say both candidates. We're all under the assumption, I guess, at this moment that is going to be Biden. But if it was Biden stepping aside and it's going to be someone else, does that change the playbook?
Yeah, I think it has to. Obviously, it depends who that candidate is and when it happens and under what circumstances it happens, right? Obviously, you would think if Vice President Harris takes over the ticket, those policies will probably be more in line with what's happened the last couple of years. If you bring in a new candidate, then, there's clearly policy uncertainty around that. Even if they want to toe the party line now, once they were theoretically in power, you don't know what direction that policy is going to go. So yeah, you have to add some sort of uncertainty premium in if that happens, I think.
I love the way you framed things in some of your recent research. You said medium term, election risk and growth worries, whether you talk about the jobs market or you talk about consumer spending, will kind of rule the roost when it comes to market activity. Near term, it's the inflation data and the start of earnings. You think that the start of earnings really does begin with the banks. Are they going to really give any sense of the direction of travel, or are they just sort of a world unto themselves?
I think people will look particularly to the CEOs and how they're talking about economic and lending activity, right? So I think there is a signal there in terms of what do the banks view the outlook in terms of economic growth as, and particularly from a credit risk perspective. Those will both be very important. But to your point, as a share of market cap and a share of earnings, they're much smaller than they have been in the past. And to be completely honest with you, a lot of the large banks have generally guided or talk negatively about the economy for most of the last couple of years. So how does the market react to that? Is it sort of a boy who cried wolf situation, or given the actual slowing we're seeing in economic data now, do those comments kind of carry a little bit more weight? So I think it matters much more from that perspective. What are they saying about growth? What are they saying about lending and the strength of the consumer? Yeah,
a lot of people say that it's because they've been reporting record profits, so they want to talk about how they recognize that people are hurting out there to sort of mask the incredible boon that they've been having. How do you see, in general, though, the balance of risks as market participants are kind of worrying about them in terms of a weakening in growth picture that's maybe a little bit more than this immaculate disinflation?
Yeah, the growth has definitely turned a little bit the last month. And I think the key part of that is it's just gotten more broad. It used to be we had pockets of weakness here. Now it just seems more collectively we're seeing a broader base slowing in economic data. And that's definitely gotten people's attention. I think that's why the banks will kind of matter from that perspective. In terms of risk reward around earnings, it does seem like the bar is a little higher. This quarter, if you look back to last quarter in particular, you had a lot of large cap stocks, particularly on the consumer side, really discuss some weakness, whether that was McDonald's or Starbucks or some others in that category. So, the bar is pretty high going into earnings, just, both because the price is high and also because I think when the economic data is slowing, you really want to see that earnings and the earnings guidance and outlook kind of buttress things. So it matters.
You've been very consistent about this. When the data gets bad, it's time to sell. How close are we to that so-called danger zone in the labour market? Because your colleague, Andrew Hollenhurst, you always reference him in your research. He says we're pretty close.
Yeah, I mean, I guess we're getting closer by the day. It's the tough part, I think, with the economic data right now is this sort of soft landing versus hard landing boundary that you could kind of push up against. If you believe in the soft landing, that's great, but as you're approaching a soft landing, you have to obviously increase the odds that the hard landing is actually where you end up. And I think that's where what the market's struggling with a little bit right now is it does feel like we have to thread a needle a bit. The economic data is much more broad-based weak. And there are some sort of key things within the labor market that an economist in particular is like, this is a big deal. And then, kind of like the meathead strategist in me is saying, we just printed 206K. Like, why do we care about that, right? So I think there's that ongoing kind of debate. And look, it's gotten our attention. I think we're getting closer and closer to the point where the market's going to need to make that decision. And our view is if you're betting on a soft landing, it's just a very poor risk-reward trade. Because let's just use payrolls as an example. Once you get below 100K payrolls, you have to really increase the risk that you're going to go negative and end up in a recession. So even if you believe you're going to soft land, you're sort of threading a needle, and the risk reward around that trade is very, very tricky. And I think that's why small cap in particular has been under so much pressure.
Can I just ask you about the SARM rule? Mm-hmm. I can't think of a single cycle where the SARM rule has been talked about more than this one. And it's investors, it's traders who reference the SARM rule more than I think economists or anyone at the Federal Reserve. How do you think this market would respond if unemployment did climb to 4.2% in the next month, even if Fed officials are sort of hands-off and sort of de-emphasized it? Do you think this market would start to behave as if a recession had started?
We would. I mean, I don't know if I would say a recession has started, but I think if you start to trigger a rule like that, as you know, we've been acutely focused on the labor market, right? And I think if you get unemployment accelerating in that way, you have to respect that, and you have to take some risk off the table and kind of hedge it, in my opinion.
Another 10 basis points in unemployment. What's your view on this market?
Look, we're kind of splitting hairs there, but yes. I mean, if you get unemployment rate, let's say above 4.2, or you're approaching 4.3, then yes, it matters. The same way if on payrolls, if we printed 85K, I think you have to respect that as well. So So, yes, I think it matters. That said, you've had other quote unquote rules, a lot of them related to like 2s, 10s or what the rates market's telling us that have just proven ineffective, frankly, over the last 12 to 18 months. So will the SOM rule matter? Yes. If we trigger it, it will matter. And I think from our perspective, you have to respect that is an additional negative on risk reward going forward. And we'd probably, tell people it's time to, reduce risk or be a little more careful if that were to happen.
Stu, this was great. It's good to see you. Stuart Kaiser there of Citi. Your equity market just about turning positive on the S&P 500. Let's get you some stories elsewhere with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Iran has elected a reformist president who wants to revive the nuclear deal. The 69-year-old heart surgeon won by almost 3 million votes in the runoff election this weekend. Turnout, though, was below 50%. The U.S. State Department said the low turnout was due to elections not being, quote, free or fair. UK Prime Minister Keir Starmer is preparing to launch Great British Energy, a public company designed to spur investment in clean energy. He also plans to convene a business task force to advise on the creation of a national wealth fund designed to help drum up private investment focused on his so-called 5 missions. Those include economic growth and clean power, according to people familiar. And Microsoft is ordering its China-based employees to swap their Androids for iPhones. Bloomberg obtained an internal memo which said that starting in September, employees will be required to use only Apple devices to verify their identities on work computers or phones. The measure will impact hundreds of workers across mainland China and is meant to ensure that staff use the Microsoft Authenticator app when logging in. And that's your Bloomberg brief. John.
It's Danny. Thanks for that. More from Danny again in about 30 minutes' time. Up next on the program, pressure mounting for President Biden to bow out.
We don't oppose the president. We simply ask him to make the very important decision of stepping aside.
Mr. President, your legacy is set. We owe you the greatest debt of gratitude. The only thing that you can do now is to step down and let someone else do this.
The conversation up next on the program, live from New York City this morning. Good morning.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest premieres Monday at 9 a.m. Eastern, only on Bloomberg Television.
Equities just about unchanged here on the S&P 500. In the bond market, yields drifting a little bit higher, up by 2 basis points, 429.98. Under surveillance this morning, pressure mounting for President Biden to bow out.
This is not just about whether he gave it the best college try, but rather whether he made the right decision to run or to pass the torch.
Voters do have questions, and personally, I love Joe Biden. I don't know that the interview on Friday night did enough to answer those questions.
We don't oppose the president. We simply ask him to make the very important decision of stepping aside.
Mr. President, your legacy is set. We do the great.
It's the latest this morning. 9 Democratic lawmakers now calling for President Biden to drop out of the race as doubts grow over his ability to serve a second term. Henrietta Treyz of Veda Partners writing this: unless Biden improves in the polls, the screams to drop out are going to grow deafening. Team Biden is putting up a valiant effort right now to stay in the race, but it is our expectation that staying in the race is untenable and the president will choose to step aside. Henrietta joins us now for more. Henrietta, it's wonderful to have you with us on the programme. Will it be the polls, the donors, officials within the party that get the president to take that decision?
Yeah, it's interesting. They're getting all three right now. The donors are leaving. The polls, the best poll that the president had in the last week was actually the Bloomberg Consult poll that y'all conducted, which showed him down in every state except for Michigan and Wisconsin. He's underwater in Pennsylvania by 7 points, I believe, in the Bloomberg Morning Consult poll. So all three of those points, including the members, are coming out against Joe Biden right now, which is why we have 70% odds that he will ultimately decide to step aside and open this up to, as I would phrase it, the chaos of what will either be passing the torch to Vice President Kamala Harris or opening it up to sort of a contested mini convention, as they're calling it on the Democratic side now.
Range of 70% odds is a big call, Henrietta. What's the timeline you could see this unfolding?
Great question. You know, these things happen very slowly and then suddenly all at once, to paraphrase. Right now, there are a lot of different big ticket items. Y'all have been mentioning the NATO events this week and Thursday, and those are all integral. But let's step back and sort of consider this from the perspective of the average voter. No one's watching that. I mean, let's be honest, Americans are not particularly enthusiastic about foreign policy most of the year. I don't expect it to be a major driver in this narrative of the 2024 election. Obviously, Israel, Gaza, and Ukraine are important topics, but in the grand scheme of things for the American voter, that doesn't register. So what I'm looking at is, when is former President Trump going to announce his VP? The number one way to supersede that announcement is to move forward with a Democratic announcement about something else. That's going to happen at the convention next week or in the days leading up to it. I don't see a lot of rationale for Democrats to step out and say, actually, you know what we're going to do? We're going to fix all this and open it up to a new situation. Biden's going to step down before the RNC. I would expect it to occur after that. So that's about a week and a half for investors to continue waiting here. We've been through this a million times with DC. You know, they don't do anything until they absolutely have to. And this is just another example of that. So technically, you wouldn't have to get any movement on this until sort of mid-August. I think we could see something. We're already seeing a lot of movement underneath the surface, but a real action after the RNC.
But mid-August puts this potential individual that may step in to take Biden's place at a disadvantage. You right now, no Democratic candidate can beat Trump when it comes to name recognition, national stature to compete with Trump. Who would have the best chance?
Right. So that's exactly the case right now, except we're already talking about Gretchen Whitmer, Gavin Newsom, Pete Buttigieg, Kamala Harris, and name recognition in all the polls that have been conducted of those candidates is increasing rapidly. Due to this concept of the invisible primary, where voters have expected either Biden or Trump to drop out of this race all year, people are primed to learn about a new candidate. And so what you're seeing is that name recognition is going through the roof very quickly, and you're seeing improved polling for members like Kamala Harris, even Gretchen Whitmer or Gavin Newsom, which are sort of the second and third tier candidates on that list. Kamala Harris is far and away the front runner. I think what we are focusing on here is that 24% of the electorate, including mostly independents, decide who they're going to vote for after Labor Day. So there's about 60 days from now that matter most in this election, and we're not there yet. So any of these Democratic candidates, I think, have the benefit of what will be an onslaught of media, sort of free or sort of earned media. The way that we're most familiar with on the Republican side with Trump since 2016, that earned media that you don't have to pay for, that comes from just natural attention and intrigue. And that's now housed within the Democratic Party for the first time since 2016.
Henrietta, I've been confused by some of the polls after the debate and after that interview with Joe Biden on Friday night. Some have shown a widening in the gap, widening of the lead for Donald Trump. Others, like the Bloomberg Morning Consult poll, showing a narrowing of Trump's advantage in the swing states. How do you understand this? Is basically any press good press? Is it that people already knew about this and this was already factored in? How do you sort of reconcile the different narratives that we see?
I think it really hinges on, for lack of a better phrase, attention to the Democrats, certainly, but the fact that Donald Trump has not grown his base. So it's not that Trump is improving, it's that Biden is deteriorating. Trump is at his ceiling. That has been the case since November. The question is, can you beat 47, 48%, which is where Trump sort of plateaus? The bulk of Biden's supporters, 63%, are actually just people who don't like Trump. So it creates a scenario where the Democratic voter base and increasingly independents, moderates, and in particular female voters are primed to migrate to whomever the Democratic Party taps next. It really matters less who that candidate is than the fact that they're not Trump. And that's just the nature of the duality between Trump and the Democratic Party right now.
Let's catch up in the next week or so. Henrietta Treyz there, Veda Partners, with a call that the president will step aside. Think about the spread between officials within the Democratic Party and the rest of the country. Spread's narrowing because the Democratic officials are waking up to the reality that the rest of the country's been looking at now for months and months and months. Where have they been?
The conspiracy of silence was among some of the Democratic elites. It was not among the rank and file who are watching all along.
Coming up on this programme, more on the US election, the prospect of a Trump presidency and what it could mean for policy and monetary policy next year. Adam Posen at the Peterson Institute up next. Just want you to think about a number. the average target on the S&P 500 for year-end 24, coming into 2024, before all the upgrades of the last few months, 48.33. Equity futures look like this on the S&P, unchanged today, but we're talking about 5,600. And Mr. Stolfus over at Oppenheimer is now talking about 5,900. That's his news price target on the S&P for year-end. It was 5,500. Lisa, Mr. Stolfus is now the second most bullish on the street.
And he basically gave a nod to the fact that he was going to do that when he was on the show, but said that he couldn't do it before actually publishing. He basically is saying there's no reason to really slow down with some of the leaders. You see that dynamism under the hood. It doesn't matter whether the Fed cuts rates, as he said all along. And frankly, right now, he doesn't see a reason to stop betting with momentum, which has ways more to go.
I will say it's only July. There's some way to go this year, and things can change. We've only just started talking about policy coming out of Washington. We're starting to see the cracks in the labour market as well. And you can see that breathing some life into this bond market just as it was selling off. It started to rally on a weak, and I mean really weak ISM, surprisingly weak ISM services going into the July 4th holiday, Lisa, the 10-year, 430.18.
You know, Stuart Kaiser summed it up beautifully, I thought, where he was talking about how betting on a soft landing is a poor risk-reward trade, talking about how people have already baked in this narrow landing pad for basically inflation coming down and growth cooling just enough. Now we're getting to sort of this crunch space, and you can feel that tension playing out in the bond market. On one hand, you've got some of the fiscal overhang, which people have talked a lot about. There are auctions this week. We don't have to get into that. But you also are talking about this idea that growth is slowing, and where else are people going to park their money?
You can't do that. You've got to give the auctions now.
They're $58 billion of 3-year notes on Tuesday, $39 billion of 10-year notes on Wednesday, $22 billion of 30-year notes.
You've remembered all of that.
She's like an AI auction bot.
I know, it's like, you know, Lisa plugs into the Bloomberg in the morning, powers up, and then comes on TV. I want to talk about the SARM rule. Let's talk about the SARM rule. So the 3-month moving average of the jobless rate rises by about 0.5 percentage point over the low of the last 12 months. OK, so if we get a 4.2% triggered, and ultimately the way people view that, maybe not Claudia Sahm herself, would be that we're in a recession, it started, let's get a move on and cut interest rates. It's amazing to me how many officials don't talk about this and how many investors do talk about this. You mentioned Stuart Kaiser, and it's the reason I bring this up. Stuart Kaiser said to us moments ago that basically if unemployment climbs by another 10 basis points, he's changing his call on this market. You get to 4.2%, some rules triggered, and they're going to go bearish on equities. A massive change in their stance on another 10 basis point move on unemployment.
This is what happens when you have people trying to basically dance on the head of a pin, get to the place where they can just cross over and say, OK, now we can sell out of a market that feels a little bit frothy in the light of some real signs of weakness. I will say the fact that every revision that we've seen in the labor market has been downward, has been fewer jobs. We see the jobless numbers climb just bit by bit by bit. It's making people nervous, but not enough to bet against momentum, as we heard from John Stoltzfus. So there's going to be a trigger point, and you just wonder how violent it's going to be if you trigger something that gets into the heads of people who already are concerned about growth.
The next unemployment report, the next payrolls report, is going to be much more closely watched because of that issue. Let's turn to foreign exchange. The euro right now, 108.30, going into the second round of the French election, wondering whether Marine Le Pen could win. We knew that the left was getting together with Macron to try and stop that from happening. I guess on that front, Macron succeeded. But when it comes to the governability of France, you've got the left in front, you've got Macron at second, Le Pen in third, and ultimately you have gridlock as a consequence.
George Saravelos, I thought, was brilliant when he said that this consequence isn't playing out in a violent move that we're seeing in the currency, but longer term, it makes the U.S. election that much more important, given the fact that Europe's ability to respond to crises is dramatically reduced the more you have an inability to rule some of the major economies in the region.
The euro at 108.30. More on that a little bit later. Under surveillance this morning, Boeing set to plead guilty to criminal conspiracy in connection with 2 fatal crashes of its 737 MAX jets. The company facing a criminal fine of as much as $487 million under the agreement with US prosecutors. This has been now on a table, Lisa, based on our reporting for the last week.
To me, the idea that it is a government-appointed oversight is actually interesting. How much they really wanted, a lot of the people, the victims' families, wanted this to be an independent kind of oversight. Why hasn't it happened sooner, given how much we're talking about it? That's all I can say.
Well, how complicated is this going to be for Boeing, which actually does a lot of interaction with the government because it's a major defense contractor? Now the government is saying you have to take a guilty plea, but of course we need to still do business with you. It feels like a very low point for Boeing.
That's the latest on Boeing. It gets lower, that low point. I mean, we've been saying that for the last 6 months or so. Let's talk about the latest in the commodity market. Oil is trading lower this morning, even after Hurricane Beryl made its way through the Gulf of Mexico and made landfall on the Texas coast. Officials urging residents to take caution as oil companies adjust operations. These things happen. We see them increase in frequency, and it seems to be happening a little bit earlier this year.
And so we can go into the climate forecasting and understanding just how bad this hurricane season could be. You were talking about the commodity response to it. And Torsten Slok, right on cue, put out this chart talking about how for the first time in more than 60 years, U.S. energy production is now higher than U.S. energy consumption. The offset to some of these potential headwinds, whether it's the potential for a hurricane to disrupt supply, whether it's Middle East disruptions, why haven't we seen more of a reaction in terms of higher oil prices? That's the answer.
Absolutely. It's the U.S. exceptionalism when it comes for these, quote unquote, what this administration was calling at one point stranded assets, but actually they're pumping a record that no country has ever seen, ever. The issue, though, for this summer, and Onyx Capital puts it a really good way, it's contingent on weather. But I would also say it's also contingent on what's going on in the Middle East, what's going on in the Red Sea, and potentially if we were to see this ceasefire between Israel and Hamas. There's geopolitical risk and weather risk this summer, and it's not something that the oil industry or the administration can control.
That would be a big development. We're down about 1% on WTI, 82.33. A final story, President Biden entering a pivotal week for his re-election campaign, vowing to continue his run despite calls for him to step aside. Adam Posen of the Peterson Institute weighing market implications of the election, writing, quote, tariffs and migration restriction are coming, which are inflationary. Whatever the election results, though larger and more stagflationary under Trump than Biden, there's an 80% chance that the Fed will hike by the end of third quarter 2025. Adam joins us now for more. Adam, wonderful to catch up with you, sir. Congratulations on the latest work, particularly on tariffs from Mary Lovely and the team, and what you're doing around immigration as well. Before we get deep into that analysis, let's just start with that Fed call for next year. Adam, are you saying there's an 80% chance, regardless if he takes the White House in November?
Yeah, 80% net. Thank you for having me back, Jonathan. I think it is slightly lower if you have Biden and much higher, meaning close to a certainty, if you have Trump. There's just too many things feeding in. Inflation coming from tariffs, stagflation coming from migration restrictions, threats to Fed independence under Trump, a rotation to fossil fuels even further and old-fashioned engines under Trump, which would be a boom that's unsustainable. And then, as we talked about last time I was on, I see fiscal laxity either way, no matter who wins Congress. There's just too much demand. The shape of the laxity, tax cuts versus spending, very different. But either way, you put all that together, and then notwithstanding the points you legitimately make about the labor market, the fact is the Fed's probably looser than it actually thinks it is. So to me, it's inflation.
That said, Adam, we're going to get CPI on Thursday, and it's supposedly going to come down to 0.1% month over month, 0.2% when you strip out food and energy, leaving us with a 3-point-something type of inflation rate, which isn't so terrible. It's come down really significantly. Why do you think that shouldn't justify a Fed rate cut, certainly in September, but even this year?
Well, there's forecast and should, right? So my forecast is the Fed will cut, probably November rather than September because of the politics, but they will cut. And then they'll have to reverse. And the question is, how quickly do they reverse? If I was sitting there, I would say, okay, I'm willing, I might vote against a cut in September, but I'm probably ready to cut in November. But I have to be ready to pivot hard when the circumstances change.
So, in other words, you think that this could be kind of a similar type of episode as what we saw in the 1970s, when it was sort of a head fake with disinflation, and then a whole host of other factors came into play. Is that basically what you're predicting, that this is going to be more like a 1970s redux than most people are accounting for?
I think, Lisa, it's a fair parallel, but I would go to the parallel of the second Volcker disinflation, that in 82, they raised rates a lot. They got inflation down. It was trending down, and then things got out of hand again. in part because of the Reagan deficits in 84, 85. And I think that's the analogy we got to look at. And that means that conditional on what they see now, we can get back to whether the sum rule applies in this situation or not. It could be reasonable. The thing is, you've got to choose. If the Fed decides that they really are going back to inflation targeting and looking at a 2-year ahead forecast, they shouldn't be cutting. If they're doing data dependence and trying not to spook people, then they maybe should be cutting. But either way, they got to be prepared to turn around, as Volcker did in 85. And that's something central banks are usually reluctant to do. So part of the reason I'm saying this is not just to get the call right, but to try to set up a ground for the Fed to be willing to reverse.
But Adam, for the Fed to reverse, we need to actually see those policies. Is there any indication that potentially Trump has rhetoric now that might not actually mean policy if he was enacted into the White House, potentially rhetoric to try to get, say, Beijing to come to the table and strike a deal?
Yeah. I think, Annalise, the possibility of that is much bigger on the trade front than either the fiscal front or the migration front. Trump keeps saying the different audiences, surrogates for Trump keep saying different audiences. This is all about a negotiating position. And if that's the case on tariffs, great. I mean, not great compared to not doing it, but that's still better than putting up across the board tariffs, as Mary Lovely and Kim Clausing said, would cost $1,700 a household more for poor households. So if that's true, great. But on migration, he's been very clear. He has legal and political authority. His voters want anti-migration policies. A lot of Democratic voters want anti-migration policies. And leaving aside the human cost, it's going to be big. He has said repeatedly, we'll do the largest migration crackdown in history. Well, the second largest, or the largest to date, was Eisenhower's Operation Wetback, which kicked out 1.2 million human beings. So we do the modeling. If it's 1.2 million human beings, that's mildly stagflationary and very inflationary. If you do 7 million, which is all illegals, as he puts it, then you're talking massive recession in manufacturing.
Leaving behind and to the side the humanitarian effects of this, what kind of deficit are you seeing in the amount of people in the labor force?
Well, Biden, unfortunately, has undercut, I guess for political reasons, or maybe some of his people believe it, has undercut one of the success stories of the last 2 years, which is we had on CBO numbers roughly 2 to 4 million more immigrants over the last few years. And this came with record low unemployment. This came with high labor force participation. They were not taking jobs from natives. They were creating jobs from natives and relieving inflation. Anyway, Biden cracked down at the border. And that's one of the things that in the services sector is keeping inflation up a bit and will get worse over time. So, like you say, leave the human side, the human aspects of this aside. On the pure economics, this is taking away the secret sauce that has made the U.S. grow without inflation and with low unemployment for the last couple of years. In addition, before we get into the stuff about high-skilled immigration and entrepreneurship, which I know you and your colleagues have covered a lot.
Adam, I want to offer you the opportunity to actually develop that idea a little bit more, give you some space to talk about it. So tariffs are regressive. Ultimately, we both agree on that. No dispute there whatsoever. There is a story on immigration that immigration has held down wages. And we hear people talk about that all the time as if that is a good thing. And hold down wages on low-income workers, Adam. And I want to understand from your perspective what the argument is contrary to that. What's the counterpoint to that?
It's a fair question, and I understand people are concerned about it because it seems like obvious logic. We're saying more labor supply, lower wages. But as my Peterson colleague Michael Clemens has pointed out, the economy isn't one market. It's a much more complex system than that. And it's a very straightforward complexity, which is, for the most part, lower skilled migrant workers take jobs that are different from the jobs even lower skilled or lower paid native born take. They're separate labor markets. When we see this repeatedly, we saw this with the Mariel boat lift in Miami. We've seen this in a lot of microeconomic studies. We've seen this in Texas right now, where they have border surges, and yet unemployment is low and wages continue rising for the native born. As Michael Clemens points out, you basically create one new job for every 10 migrant workers. For a native born person, one new job. And vice versa. You take away 10 migrant workers, you kill one native job. So it's like you have iron and copper going into a metal. You need both to make the steel. In the case of migration in manufacturing, in food service, in commodity development, in hospitality in the US, you can't make it as well without having both elements, and they're separate elements. And the evidence is there. And there's nothing strange about this. It's just the fact that migrant workers, both legal and illegal, basically take jobs the natives won't do.
So, Adam, if we can take that a step further then, if we clamp down on migration, an obvious question that people might have listened to this conversation would be, why would that lead to higher interest rates, given what you just said doesn't happen?
It's a question, you're absolutely right to raise that. It's a question of whenever you look at stagflation in the 70s, as Lisa was just mentioning, as it looked for a moment like we were going to have in 2020, the question is, how much does the recessionary effect outweigh the inflation effect? And how much do inflation expectations stay low? And if the recessionary effect is much sharper, then the Fed can look through the supply shock and say, okay, we got to cut. But especially if, as you just raised, or as Lisa just raised, that a Trump administration were to only deport 1.5 million people, the inflation effects in the short run would outweigh the recessionary effects, and they'd be very visible. And then you have all these other moving parts, the fiscal policy, the Fed attacks, the rotation into energy, fossil fuels, that would be inflationary as well. So if they do a full-on massive deportation of millions, which is horrifying to talk about, but again, as Emma said, forget the human part, then the recession is much bigger. And the Fed, sure, then that's the least of our problems, and the Fed doesn't raise. But I think more likely we're going to be in the mildly stagflationary, mostly inflationary scenario.
Got it. Adam, super thoughtful stuff. Fantastic analysis. I've enjoyed everything coming out from you and the team at the Peterson Institute. Adam Posen, sir, thank you. We've got a lot to talk about, Lisa, on two fronts there.
Yeah, considering, so here I'm thinking about this idea of jobs that Native Americans won't do. I want to understand a little bit more about that. Is there a price at which they would do that? Is there some place where there could be increases in efficiencies? Or is it just ultimately that this economy runs on people who are desperate enough to take jobs in slaughterhouses, picking cotton, in farms, et cetera, that Americans just won't do? And then the second thing is, what kind of impact is that going to have on the economy as we talk about the dual competing issues for the Fed? Basic growth as well as inflation, and that's going to come increasingly into conflict.
These are complex conversations. They're not simple at all. We're going to have to keep having them going into November. Up next on the programme, we'll talk about the economic data, the jobs data of last week, and why September is very much on the table.
I would be leaning towards looking very carefully to, especially in these numbers, and then in the next month's numbers, to think about whether September would be the time for starting to cut.
We'll talk about the prospect of cuts and hikes up next on the programme. Stocks are unchanged. Bond yields are a little bit higher to kick things off this Monday morning. Your 10-year yield higher by almost 3 basis points now, 430.57. Under surveillance this morning, September on the table.
The Fed has made it really clear that until they're confident that inflation is going to be coming down in a sustained and systematic way, they ain't cutting rates. I would be leaning towards looking very carefully to, especially in these numbers, and then in the next month's numbers, to think about whether September would be the time for starting to cut.
So here's the latest. Fed Chair Jay Powell heading to Capitol Hill this week for his semi-annual testimony. Plus, we'll get June CPI data on Thursday. Collin Martin of Charles Schwab writing this. We still expect at least one rate cut this year, given the disinflationary trend. May's inflation readings were a step in the right direction. A couple more readings like last month's PCE report would raise the prospects of a cut in September. Collin joins us now for more. Collin, let's throw in the labour market data of last week, the ISM services number for good measure. Chairman Powell speaks twice this week. Can he open the door for July? Never mind September.
I don't think so. We're not expecting a July hike. He's been pretty consistent about his idea of more good data. And I don't think we're at more just yet. I still think we're at a month or two. We expect it to continue, but if you look at those May readings, if you look at last Friday's jobs report, that's certainly a step in the right direction. But we think the idea of a cut in July is near zero.
He's saying more good data. We're talking about more bad data. There's two sides of the mandate. Can we talk about the more bad data on the other side of the mandate? When does the focus shift in that dual mandate to the full employment side of it and less about price stability?
I think we're getting there. And what we're seeing right now is when we talk about good or bad, how do you define it? Because sometimes bad is good, right? What we're looking for is not necessarily a sharp weakening, but coming more into balance. I think that's the key phrase there. And when you look at an unemployment rate of 4.1% or so, that's been an orderly rise. I heard you talking about the SAM rule earlier, why it hasn't been triggered, and because it's over a 12-month period, not over the cyclical low. So it's been an orderly increase. If you start to see more consistent pickups, you were also talking about a 4.2% unemployment rate, I think they'll start to get worried about that when you look at what their forecasts are. Because if you look at those median projections, they're not expecting a sharp rise in unemployment. So if they start to see that those actual numbers coming in a little higher than expected, I think they'll start to focus on it a little bit more rather than just talking about the balance.
There's this key tension that we've been talking about, what you do with that weakness. When you see the whites of the eyes of some sort of economic downturn in terms of the jobs market, do you buy duration? Is that a trade you can make given some of the political overhang and the fiscal concerns?
We still do. The political overhang is something we're focusing on right now. Our view there is it's really too early to get too much into the weeds because we still have a lot of time. But when you look at both sides of the election, there's really not much signs of restraint, fiscal restraint. We don't think that's going to lead to a surge in long-term yields. We think maybe it just limits the downside a little bit. But we're still okay taking duration. I know this is something we've talked about a lot here. Our key theme lately is to kind of look beyond treasuries. I mean, when we talk to our clients, a lot of them are individual investors. It's tough to accept a lower yield by moving out on the yield curve. But there's a lot of investments out there that are high quality and can match those short-term T-bill yields. So that's where we suggest a lot of our clients take duration.
A number of our guests today have said that they're actually less focused on fiscal and fiscal policies than they are on some of the immigration that we were just talking about, as well as tariffs. Do you agree with that? Do you think that's going to create a real tension next year for both the Fed and bond investors at a time where you could see increased inflationary winds but depressed growth?
Maybe. And I think your previous guest mentioned this, that it's one thing to talk about policies, it's one thing to get them enacted. So it's something we're thinking about. There are some inflationary winds on the horizon. We look at both candidates, whether it's on the immigration side, whether it's on the debt deficit side, whether it's on the tariff side. It's something we're thinking about now. More for next 2 or 3 years. In the here and now, we're focusing more on monetary policy, the easing jobs market, the disinflationary trend we're seeing. So that's our main focus right now.
Next 2 or 3 years, though, but the election is in November. We potentially get a new president in January. And if that's Trump, we can have tariffs within days or weeks. Isn't this a 2025 issue?
It could be. We still think there is time. And we think there's a lot of time between now and November. And before we make some kind of bold claim or change to our outlook, we want to see how the chips fall a little bit. And for now, we're just focusing on the trends that we're seeing in not just the hard data, but the soft data, as John mentioned before, with a lot of leading things like ISM indices.
How concerning was that ISM last week?
You know, I think it is concerning. What I've been focusing more on lately is services. You know, ISM manufacturing makes a lot of headlines, but we're really not a manufacturing economy anymore. And services had been holding up pretty well. But when you look at that number, I think 48.8, I might be off by a tenth or so there, the lowest in a number of years, and pretty much every component was down. I think maybe we saw a little pickup in new orders. But employment down, prices paid down, and just the headline, it was a pretty sharp decline. So I think that is telling. But we've seen kind of head fakes before with the soft data and the hard data. But when you look at last quarter's GDP, a little bit lower, a little bit below trend, I think this means we are going to start to see more slowing in GDP and overall spending.
Collin, it's good to see you. Collin Martin and Charles Schwab. Last week was like Brahmo Nirvana. Services ISM contracted the most in 4 years. ISM manufacturing also in negative territory, so both of them contracting. Unemployment rate above 4% for the first time since 2021. April, May. Payrolls revised lower by a combined 111K. Put it all together, Lisa, more reasons to worry.
Okay, hold on a second. Yes, I worry, but I don't need more reasons to worry. And I hope that this economy doesn't roll over into some sort of serious recession. In part, I don't want to see it tested whether the Fed has all the ammunition it needs without any fiscal support. And that, I think, is going to be really challenging. I just feel like I needed to sort of put that on the record. I'm not cheering for
No one thinks
weakness.
it's a goal of yours.
No.
To have a recession.
No, but I worry. I always worry.
It's a fear of yours.
There's constant fear.
It's an important difference. All right. Okay, feel better? Good. Third hour, up next.
All Fed officials will tell you it's about the totality of the data. So it's not just what's happening with the labor market, but what's happening with inflation.
The hope would be, of course, that rate cuts would be forthcoming.
The Fed's not going to move at the end of this month, but September is live.
I think what will cement September is really another round of data.
At the end of the day, what's going to drive the Fed in the next 3 months to September is inflation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, so here's your week ahead. Earnings on Friday. Let's work backwards. Then we've got CPI on Thursday, and right in front of us, a double dose of Chairman Powell. If you go through that right now, Lisa, typically I'd say what I'm really interested in is Q2 earnings on Friday. JP Morgan, I want something fresh. I want to know what the banks are seeing in the economy right now. Scrap that. This is what I'm interested in now. Chairman Powell speaking twice, once in front of the Senate, then in front of the House, Tuesday, Wednesday. How are they responding to what we're seeing develop in this labour market? And throw in the ISM services number last week for good measure.
Has their tipping point been breached where suddenly they think of the labor market as showing more concern than the inflation picture, which is still creeping into a better balance? This, to me, whether the balance of risks has shifted much more squarely to the labor market is a key question that I want to know, and how much they're willing to allow inflation to remain at 3 point something while they cut rates to try to get ahead of any kind of more protracted downturn of the labor market.
Many of you stateside joining us after a long weekend, welcome back. We're doing the same thing, going through the data of last week. The ISM services number contracted the most in about 4 years. You put together the payrolls report, April and May revised down by a combined 111,000. The unemployment rate still creeping higher. You look at this line by line, and Anne-Marie, things are getting worse. They're not getting better in this economy.
They're getting worse, and you have to think that this is spelling not such good signs for the Biden administration, unless it's cooling enough that potentially there's a cut ahead of the election, especially when it comes to manufacturing. This is their whole pitch. We're bringing manufacturing back to America. Well, the jobs, no manufacturing added there, and the ISM, manufacturing very low. You're interested in some of the economics and what Powell has to say this week. I am very much so interested in the test Biden faces on Thursday. It's almost they've decided this is going to be the test. He's going to be out in the public. He's going to be in front of the press. Will he have another mishap like he had at the debate? And will that open the window even further and the doors even further for Democrats to come in, now that we have a count of 9, to say he should step aside?
Our opinion is not worth anything. The questions we ask are really important. So I want to talk about the most important question. It's not about whether he can campaign for the next 4 months. It's whether the individual can campaign and then govern for another 4 years. And I keep hearing the officials in the Democratic Party talk about the prospects of winning in November, the importance of the campaign over the next 4 months, and hardly any conversation about his ability to govern for the next 4.5 years, Lisa. And the questions we ask around this table of guests on this programme, that's what we need to keep going back to. It's not about the next 4 months for this country. It's about the next 4.5 years.
And this is something that he was asked about. And he said, well, yeah, I wouldn't have run otherwise. And, you know, there is a real question about why he is not listening to some of the pushback. On that note, though, the NATO conference down in Washington, D.C. is going to be fascinating, because what about his ability to govern right now, especially with the perception of international leaders that have been watching this as well and are actually getting concerned, and they vocalize that. I'm curious how much that's going to come to light at some of these meetings.
Prior to the debate, we reported at the G7 how there was this concern in the room about Biden, his physical health, how his age comes across very physically when he walks, but also the fact that he was there a lot of the time mentally when they were talking about Ukraine, but then also there would be these moments where he almost would just lapse and stare off into the distance. You're going to hear a lot more of these leaks from foreign capitals around the world, because they are very concerned about who leads the United States, especially given the fact that there's still a war in Europe.
You were in the room with Zelensky in the last week. Fantastic work. Let's talk about how he responded. And I think this was the beauty of broadcast television as opposed to print in this very moment. When you asked the Ukrainian leader about whether he could govern in his 80s, this is not something you can write down in a quote. It was the way he responded, the way his face lit up, because that was an individual that knows he can't do the job he's doing right now, 40 years later.
He wouldn't bite when I kept asking him about, has he seen a deterioration of Biden's health? He said it wouldn't be ethical for me to weigh in. He said, also, I've been in media a very long time before I was president. There's differences potentially trying to get a sense of maybe Biden came across differently in the debate than he would behind scenes. But then when you turned it around on him, can you do the job you're doing, the schedule you have when you're 81? He just laughed in my face. He literally laughed and said, oh, I'd have to think about that.
How many moments will we get like that this week? Looking ahead to a big week ahead. Stateside in Washington and on Wall Street. Equities look like this on the S&P 500, positive by 0.03% on the S&P. In the bond market, yields bleeding higher by 2 or 3 basis points. The 10-year 430.96. And in foreign exchange, the euro not doing much, 108.33. Coming up this hour, we'll catch up with Sam Stovall of CFRA after the S&P post the best week of gains since April. Pierre Ferragu of New Street Research on why he's downgrading Nvidia. And Rubeela Farooqi of High Frequency Economics looking ahead to this week's inflation data. We begin with the big issue, kicking off the trading week at record highs. Sam Stovall of CFRA staying cautious, saying this: prudence is not synonymous with protection. Concentration has been a major concern of this market's outsized advance. Now that the S&P 500's year-to-date climb has been more than exclusively driven by a handful of tech-oriented stocks, investors have begun to quote Winston Churchill by saying, never was so much owed by so many to so few. Sam joins us now for more. Sam Stovall of CFRA, let's get straight to it. The economy is being driven by the Federal Reserve maybe reducing interest rates at some point. At least that's the outlook for the economy. Sam, I want to talk about the reality of where we are right now. We're decelerating. You can see that in the labour market data. You see that in the ISM. When we get to Friday and we hear from the big banks, what do you think they're going to say about what they're seeing in this economy?
Well, I think, Jonathan, a lot of the CEOs of the big banks have been pretty cautious, even though they're very happy that they just passed their stress tests. They are cautious about the consumer. They're cautious about the economy. And I think right now what's helping to support the market is the majority expectation that we will experience a soft landing, not as Lisa worries about heading into a recession. And I remind investors that hoping is a lot more beneficial than having, because in the 6 months after we have seen the first rate cut, the S&P was up only 5.5% versus being up 15% as it awaited the first rate cut.
Sam, being hopeful pays off in the equity market, that's for sure. And as you say in your work, a market in motion can tend to stay in motion. We just had a guest, though, in the last hour from Citi, Stuart Kaiser, who said if we climb another 10 basis points in unemployment, he's going to turn bearish on this equity market. Now, what's important to me is whether he's alone or not. And I imagine he's not going to be. What would you say back to that?
Well, I would say that, yes, historically, when we have seen at least a 0.6% change in the unemployment rate off of the bottom, that ends up being favorable to the likelihood of a slowdown or a recession. So right now, even though we are not forecasting a recession, I do have to look to historical precedent. And certainly this time around, history has not been a very good guide. Typically, we've seen the inverted yield curve, leading economic indicators, earnings recessions, et cetera, all point to an economic recession, which just has not materialized. So does the boy who cried wolf finally get patted on the back for being correct if it was many, many months and years after the first call? So I would tend to say recessions have not been repealed, but they have certainly been delayed.
If you are optimistic that this is going to be a soft landing, that we're not going to get that kind of recession, at what point can you bet on the broadening out that never happened? You say you're worried about concentration risk. A lot of people have raised this concern, and they say they're going to try to go to some of the less loved 493 names. It hasn't worked out. When does it start to work?
Well, that is the real $64,000 question. I mean, is this market similar to what we experienced from April of 1998 to March of 2000, when the advanced decline line was heading south as the S&P was continuing to move north? Yes, I do worry. I do look at the valuations right now in the S&P 500. I see it's trading at a 35% premium to its average over the last 20 years. We look to the tech sector trading at a 74% premium over the last 20 years, and the highest level going back to the 2000 tech bubble bursting. And then lastly, just looking at the relative strength between the equal weight tech and the cap weighted tech, we're more than 2 standard deviations above the mean. So I would tend to say that we do need to experience a resetting of the dials for me to feel that this bull market is not at risk. And who knows how long this will continue until we do get that reset.
How are you expressing your caution? If it isn't necessarily getting out of some of those names more aggressively, is it holding more cash? Is it offsetting with, say, utilities that were considered defensive at one time and then now there's some questions?
Well, utilities have been benefiting from the euphoria of AI. 3 or 4 of the top utilities within the sector, take them out, and the sector itself would have continued to underperform. So really, I think you have an awful lot of groups that are within tech, that are peripheral to tech, that are benefiting from the tech euphoria. So the real question is, are we likely to be seeing a rotation? And right now, I continue to see the percentage of sub-industries, and there are 154 of them in the S&P 1500, a percentage of them declining when you look at those above their 50-day, above their 200-day, and above both of those levels, which implies to me that we are not getting the participation that we should. So for me, I have to wait to see what the market is likely to be doing. Will we continue to see the softening as we await the changes in earnings for this second quarter? Right now, expectations are for an 8% gain, with 8 of the sectors in positive territory. So I think investors are saying prices lead fundamentals, and the fundamental picture will be improving.
So do you just ignore the politics?
No, I mean, politics is headline, but the real question is the bottom line. And I think the concern is that should former President Trump get reelected, then we do have the tariff threat out there, and we do have concerns for additional debt being added to the books. And that could be the undoing of the market if we tend to see the 10-year yield start to climb once again, and in a sense throw off the valuation picture even more so.
You're not alone pondering that question, Sam. It's great to get your thoughts. Sam Stovall there of CFRA, blending some outlook there on the banks reporting this Friday and ultimately on concentration risk. So let's talk about that in one story. Talk a lot about what tech has done over the last 12 months, year to date. The Mag 7, Nvidia, all of that. OK, park that. JP Morgan's up 20% year to date. Goldman's up 20%. Citi's up 24.5, let's call it. Bank of America's up more than 20%. I throw in Deutsche Bank over in Europe is up 26%. Banks have had a decent run, never mind just big tech.
That's because capital markets are going gangbusters. If you take a look at some of the M&A transactions, you could just look at all of them as truly M&A Mondays today. You could talk about some of the debt raises, some of the even equity raises that people have gone out there to do. You could see activity creeping back as people get confident that we've gotten peak rates. And that, I think, is going to really support the bottom line in addition to higher rates.
Equity futures right now just about positive on the S&P 500. Let's get you some news elsewhere with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. Hurricane Beryl made landfall on the Texas coast early this morning. The Category 1 storm brought heavy rains and life-threatening storm surge to Texas after causing devastation and destruction in the Caribbean and Mexico. Beryl is forecast to move through the lower Mississippi Valley and Ohio Valley tomorrow and Wednesday. Microsoft is ordering its China-based employees to swap their Androids for iPhones. Bloomberg obtained an internal memo that stating in September, employees will be required to use only Apple devices to verify their identities on work computers or phones. The measure will impact hundreds of workers across mainland China and is meant to ensure that staff use the Microsoft Authenticator app when logging in. And after a 945-day victory drought, Lewis Hamilton notched an emotional win at the British Grand Prix on Sunday. It marks his 104th career win and his 9th at home in Silverstone, a record for a single circuit. Periods of rain led to a dramatic battle for the podium, with Red Bull's Max Verstappen clinching second and McLaren's Lando Norris third. It was Hamilton's final British GP for Mercedes before he joins Ferrari next year. And that's your Bloomberg Brief. John.
Danny, thank you. Just a beautiful moment when a radio message came up and he was choking up at the end of the race. Little tear. in my eye, never mind his. Beautiful.
Yeah, I actually watched the soccer.
Oh, did you?
Yeah. So
which game did you watch?
I watched a number of them. Hold on a second. Which one was the best one? It was probably England losing yet again, having a tough time of it. Although they think they came back, right? I watched some of
So you
those.
clearly didn't watch the end of that
No,
game.
I didn't.
All right. Okay. All right.
That's
Moving
key.
on.
Watching the end is pretty key in soccer.
Lisa, all right. I think we need to chat about how to watch sport. You have to wait to the end.
I hate that. It's really stressful.
You don't get to select a score. You know, that's not how it works. Like,
there's a couple of good moments.
I like that score. It's finished now. England lost. It's 1-0. You have to watch the next 10 minutes.
Okay, all right. Let's move on.
The penalties. Okay, we'll move on. No. All right. Up next, the morning calls. Pierre Ferragu of New Street Research with a rare downgrade on this stock, Nvidia. The conversation's up next. Less sport and a lot more tech. From New York, this is Bloomberg. I can't let it go.
Okay.
No, I can't let it go.
It was on in the house, and I was watching a couple plays.
She watched moments of games.
I was watching moments of games. Switzerland looked good. England looked bad.
I'm genuinely jealous.
Germany looked really good. Well, they played really well.
I could create my own sporting reality. Watch a game, and when it gets to a score I like,
all right,
switch it
off. Are we done?
And pretend that's the result.
Fantasy football?
I guess you probably
Okay,
could.
are we really done?
You could do sort of Gramo fancy football. She decides what the score was.
Fantasy world.
Turn the game off in the 80th minute.
You know, the auctions are coming out tomorrow.
Yeah, sure. All right.
Wednesday and Thursday.
I
know. You're going to keep going. I was watching different moments of games.
Years.
And of course, I shouldn't have said anything, but I just blurted it out.
We still have 3 more games left. This is going to be fun.
I know. How Bramo watches the final in a few weeks. All right. Futures look like this on the S&P 500. We're so coming back to that. Equity futures unchanged. Yields a little bit higher, up 2 or 3 basis points. The 10-year 430.57. Let's get you some morning calls. First up, Wolf Research downgrading JP Morgan to peer perform. The analyst recommending investors take some chips off the table, citing exposure to net income interest headwinds and a rich valuation versus its peers. Next up, Wells Fargo raising its price target on Alphabet to 187, maintaining an equal weight rating. The analyst expecting solid second quarter results, but also expecting a slightly more challenging catalyst path. And finally, Pierre Ferragu of New Street Research out with a rare Nvidia downgrade, slashing his rating to neutral from buy. Pierre saying the upside for the AI giant will only materialize in a bull case, adding he would only buy again on prolonged weakness. Pierre joins us now for more. Pierre Ferragu, that's quite a headline, a downgrade to Nvidia. Just tell me, what are you seeing in the company? Is it what the company's doing or what the stock price is doing that's led to this downgrade?
Yeah, it's a great question, John. What we've been doing over the last 18 months following NVIDIA and being very early in seeing this AI inflection is that we've been comparing what's happening for NVIDIA, what expectations are on NVIDIA, with what the supply chain of NVIDIA is lining up in terms of increasing capacity for this accelerating AI infrastructure deployments. And for 18 months, we've always seen expectations for NVIDIA being below what the supply chain was planning. So every quarter, we said they're going to beat because they're lining up more capacity than what expectations imply today. And as we did that check in the last few weeks, we realized that now, when you look at expectations for NVIDIA for 2025, with like data center revenues up like 50% or so, it actually lines up pretty well with what memory manufacturers are telling us about their capacity plans for HBM. It lines up pretty well with what TSMC is telling us about capacity they're lining up for CoWoS. And so we came to the conclusion that for NVIDIA to beat expectations again, we would need to see first the supply chain increasing further their capacity planning. And we felt that was a good time for us to actually signal to investors, to our clients, well, you have to be careful because this business has grown like 10x over like the last couple of years, like the data center AI business of NVIDIA. And at some point, it's going to take a breather. It's going to slow. It's going to stick where it is. And seeing expectations for NVIDIA meeting what the supply chain is anticipating felt like a good point in time to grow more cautious about the stock. And then valuation is relatively secondary. I think the valuation of NVIDIA is still reasonable, but it's rich enough to suffer if NVIDIA disappoints, not by missing expectations, but by not beating them.
Pierre, there's a distinction between a valuation call where maybe it's just gotten over in its skis and it needs to pause for a bit versus the Cisco trajectory of big up, big down, how it was the darling in the early 2000s and then it really lost some luster. Do you foresee that type of reaction in NVIDIA, or do you think it might just plateau for a while or even dip before continuing its dominance over the field?
Yeah, there is no, really, we don't see any challenges on NVIDIA's market position. NVIDIA is a market leader. Like one of our key angles of understanding this market is that it's not a market in which you have to do the best chip. It's a market in which you have to do the chip that people are going to use the best. And today, NVIDIA is largely dominant in the data center for AI from that perspective. So we think they're going to continue to have a very, very strong market share. You have more room for challengers like AMD, of course, and we expect actually in-house chips to continue to take share. But NVIDIA will still by far be the dominant player. We still have very strong margins. And we don't see the AI bubble, collapsing badly and going away. It's more of the latter, that at some point, after like 2-3 years of explosive growth, of like resetting the size of the market to where we are today, we see a risk that things stabilizes, and that's where the stock could take a dip. And we would be very, very constructive on that and see that as an opportunity to get back in the stock, of course.
Pierre, the stock has 65 buys, 7 holds, just a 1 sell. I've got to ask you this question, almost as a friend. Just the career risk associated with not being bullish on the most bullish stock on the planet right now. Pierre, how do you think about those things when you're putting these calls together?
Thanks for the question. It's a very good one. I am an independent analyst. I don't work for a bank or for like a broker. And so my professional success is about, how much my clients value my opinion. And I think people who follow us, who support our research, value that my ability to say, maybe I'm wrong, but I see things that I was not seeing in the last 18 months. So things are changing. And I think publishing research like that might upset a couple of people because the stock reacts negatively on the day or in the couple of days following it. But overall, what really matters is we do the numbers, we do the math, we look at what Micron and Samsung and Hynix are saying, and we compare that to what expectations are for NVIDIA. We look at what TSMC is saying, and we compare that to expectations for NVIDIA. We look at where overall capex are as well, like the hyperscale capex have increased very significantly, and we think they're going to increase again very significantly next year. And so we're worried that there isn't much room for this capex to increase further beyond that. And so I think that work is always valued. So I don't feel like I'm taking a career risk. Well,
we certainly value your opinion, Pierre. And I don't think you're taking a career risk either. Pierre Ferragu of New Street Research. Pierre, thank you. One of the best out there. Top analysis, just thinking about this. But that's how people think about some of the analysis going on stocks like this, that if you've got a sell on it, you're running some risk because you're missing out on the move.
Let's take it a step further. How about being a mutual fund where you're trying to outperform? If you don't own these stocks, you have lost. So in other words, what kind of career risk is it not to own it, not to actually actively be bullish, let alone recommend that clients should be bullish?
I heard so many stories like this from the late 90s. People who were sitting there saying, banging a table, saying this is a bubble, and ultimately missing that final boom, that big run-up in that last year.
And we heard that today, which is essentially, do you really want to get in the way of a freight train? That markets that don't have a reason to stop going up are going to keep going up. We heard that from Sam Stovall. So even though people could be cautious, to bet on that, it becomes tricky.
A trade for the brave to bet against that. Coming up on the programme, Zach Griffiths of CreditSights alongside Rubeela Farooqi of High Frequency Economics. Chairman Powell, 2 days of testimony coming right up. Equities look like this on the S&P 500, 60 minutes away from the opening bell. Record highs at a close on Friday, a fourth consecutive day of gains. Will we add some more weight to it? The standout, the outlier of last week, the Russell down on the week by 1%, even as the S&P and the Nasdaq puts up the best week since April. This morning, Russell futures positive by 0.5%. Switch up the board and get to the bond market. Some great conversations throughout this morning. One of the best, I think, from Deutsche Bank and George Saravelos, really teeing up what a change in trade policy could mean for monetary policy on both sides of the Atlantic. We thought a lot about what it would mean for the Federal Reserve. I think we've got to think a little bit more about what it could mean for the ECB. The disinflationary shock that you could see if you get all of that overcapacity out of China being eaten by the Europeans because we have another round of Donald Trump who puts up the walls even higher.
This goes to what Peter Scheer has been talking about, too. This idea of we're missing the boat when it talks about China's effort to try to create, not just copy and just sort of manufacture, but be the actual initiators of a lot of these goods. Key question is, how much is this going to happen regardless? Because honestly, at this point, we've seen that the U.S. has much more stringent rules to try to keep out certain Chinese goods than Europe. And that, I think, could become a currency call increasingly if you see that actually come to the fore.
Adam Posen, 60 minutes ago, of the Peterson Institute, he said you get a Trump presidency, Fed's hiking in 25. No question. He said regardless of who's the president, come next year in 2025, he thinks there's an 80% chance the Fed is hiking next year anyway, because the trajectory for some of these issues, which is what you're getting at, you're alluding to, don't shift that much, regardless of who the candidate is that ultimately wins.
The issue here, and this is something that we were teasing out both on air and in the break, is this question of the dual mandate. What does growth do if you have some of these more inflationary policies? And in the face of some more stagflationary mix, what is the Fed's response? Is the Fed going to prioritize inflation in the same way as they have in the past if it is sort of an external kind of shock that creates that could potentially be somewhat temporary? These are some of the things that people are trying to tease out. It's unclear right now, which is one reason why you're seeing confusion in some of the bond price action.
I thought George Saravelos was very thoughtful when he talked about this, because he said, yes, there is this idea that direction of travel when it comes to tariffs is quite similar between Biden and Trump, but it's the speed and the magnitude under the Trump administration which is really going to make it inflationary and very difficult for this Fed to fend off.
That's the politics and policy stateside. Let's talk about Europe just briefly. If you switch on the board and get to the euro, 108.41 is where euro dollar is. 320 is where the French 10-year is. We're just about unchanged on both of those issues. I just want to say this. I think we're unchanged on the overall issue of governance in France as well. And the market ultimately, Lisa, doesn't really know what to do with the results over the weekend, with the leftist alliance ultimately taking first place, Macron's group coming second, and Marine Le Pen's right-wing party coming in third.
You know who else doesn't know what to do with it? France, because frankly, they have a lot of uncertainty right now being baked in. Question is, can Emmanuel Macron create some sort of consensus, sort of left-center consensus or coalition? And if he can't create some sort of coalition to govern, there's going to be a real question about how long he can continue in that role. And those are some of the questions at a time when either way it creates a response function that's highly in doubt from France, among one of the major European economies in the face of a lot of these major issues.
Yields just a little bit lower by a single basis point at 320 on a French 10-year. Under surveillance this morning, the dam is very much breaking. At least 9 Democratic lawmakers are calling for President Biden to end his re-election campaign. Bloomberg reporting that Democratic Senator Mark Warner will not hold a previously scheduled meeting today to discuss Biden's bid. Talks will continue during a regularly scheduled caucus tomorrow. Congress is back. There's only one thing to talk about. It's this right here.
Absolutely. And does this 9 grow to a larger number by the end of the week, given that lawmakers are going to be back in town and they're going to have these meetings, whether or not they're in the public or behind the scenes? The dam is breaking. Does it get even harder for Biden, given the fact that Thursday he is going to be on display? And this is a test he really needs to overcome. Sure, he gave this sit-down interview on Friday, which a lot of people, including Senator Murphy, said he didn't think that did enough to assuage concerns. How does he act on Thursday? Because everything he says, every movement he makes is going to be under a microscope.
I just wonder about the time limit. Charles Myers saying that he basically had 5 days. And you have to wonder how much time he would have to give another candidate to really develop their nomination, to really gain enough steam. I just wonder how much time there is and what kind of action people could take if they feel like that time is kind of running out.
Well, we're basically 4 months to the election, but Henrietta Treyz made a very good point. No one really cares until after Labor Day. And she said there's already been this, quote, invisible primary happening on the Whigs. All of these names, yes, they don't have the same name ID and recognition the way Biden does, but names like obviously Kamala Harris, Gretchen Whitmer, Newsom, they have been there in this invisible primary, and she said the polls show that there is this appetite and yearning from the electorate to want to be introduced to someone new.
Can we extend the theme of career risk? Talked about it briefly with Pierre Ferragu. The career risk associated with coming out on the record now, if you're a Democratic official and saying what some of them are saying, versus the career risk of not saying anything. What do you think is the greatest risk? Because I think the vice president's between a rock and a hard place right now. The vice president comes out and says something similar. I'm not sure anyone thinks that's going to happen anytime soon, but let's say it did. If Kamala Harris came out and said things the way these guys are saying things, everyone would say it was out of self-interest. If she doesn't and ultimately becomes the nominee, what are people going to say then about what wasn't said over the last 12 months?
They're going to say, did you see this behind the scenes and didn't come forward with it earlier than the debate when it was on full display for the American public? She's in a very difficult position, but the problem is her name's on the ticket.
That's the latest on the politics. Let's turn to Boeing. Set to plead guilty to criminal conspiracy in connection with 2 fatal 737 MAX crashes. The plane maker facing a fine of as much as $487 million and will install a corporate monitor as it bolsters its compliance program. This has been on the table for much of the last week. That stock in the pre-market is positive by 0.9%. Elsewhere, investors are looking ahead to a busy week of data and events. Fed Chair Jay Powell heading to Capitol Hill for his semi-annual testimony. Plus, we'll get key inflation data, including CPI and PPI. Bloomberg's Mike McKee joins us now for more. Mike, out of all those events, what's top of the pile for you?
Well, top of the pile for me is going to be Jay Powell on Tuesday and Wednesday talking to the House and Senate. We'll see what he has to say about what the possibilities for a rate cut are. I think the possibilities are good, which he may say. The question is timing. Does he give us a sense that it's September? And then after him, we get the CPI, which is going to be very important in the market deciding whether it could be September or not. So you got those two events going on, all of which could be overshadowed by the Biden drama, which will be into the markets if something happens. So I expect Powell might get asked about that during the next 2 days, and he will duck under the table, I'm sure, if that happens.
And we've been talking about that. I find that fascinating, and I'm wondering if any Congress member can actually come out and follow up and say, can you just give us a sense of how you weigh your dual mandate, of which comes first? Unemployment and sort of the jobs picture, or whether you're looking more at the inflation aspect of this. Do you still pledge to bring down inflation to 2%, even at the expense of jobs, if it comes as a result of some of these policies? How much are we getting a sense of that right now?
Well, he'll just repeat what he has been saying, and this will probably come in his opening statement because it's the basics for them is that they are committed to 2%, and they're going to keep going until they get there. Doesn't mean they can't cut rates before that. And he's also been saying, as have them all, that we're now paying more attention to what's going on in the labor market, that the risks are about even, but we have more work to do, so we're not cutting rates all the way down. As soon as they start hinting that they cut rates, then we go into a different discussion of how far do they go. Traditionally, they don't start without doing at least three total cuts, but do they go beyond that?
Mike, more people are talking about 2025. You heard our Adam Posen conversation about tariffs, about what migration, what this will mean for inflation. At some point, will Powell lean into what potentially this could mean for a Federal Reserve?
No, he will avoid that as much as possible. And the reason makes sense is these are all speculative situations. I mean, we don't know who's going to be president. We don't even know who's going to be running for president for sure right now. So what policies are going to be adopted for 2025? We know there are some big risks. We've got the tax bill, we've got the debt ceiling, and of course, just funding the government itself is drama a lot. And until the Fed sees what's going to come of that, they're not going to be able to make any decisions. Their first meeting is in 2025 is only 9 days after the new president takes office. So it's going to take a while for all of this to percolate through. Not to the markets. The markets will react any time. But for the Fed to think about what to do, it's going to take time, and they'll want to see what's actually happening.
We'll be patient, of course, Mike. Super patient. Mike's going to stay close. Joining us now, we won't be patient at all. Zach Griffiths of CreditSights alongside Rubeela Farooqi of High Frequency Economics. Rubeela, a question that I had last week, many others as well. The data last week, never mind opening the door to September, does it open the door for a real conversation, a live meeting in July about cutting interest rates?
Good morning. We think the data cumulatively, if you look at the growth side of things, if you look at spending, if you look at inflation, and then, on top of that, what you're seeing in the labor force. What you're seeing is there's better balance between inflation and the labor market. And we do think that there's enough evidence in the data to at least start the conversation. We don't think there's enough for them to move in the July meeting. They get more information between July and September that's going to be important. So I don't think they need to rush the decision. And also, this Fed is very careful about not surprising the markets. But I think the discussion definitely can start, especially if our outlook, if things do turn out the way we expect them to, which is an ongoing slowing in what we're seeing on the growth side, and also in terms of what we're seeing on the labor market. That is very key. That rise in the unemployment rate for 3 straight months. The unemployment rate is still very low, but perceptions about the labor market from households, they have deteriorated. And that is going to be a very key input into how households approach, the outlook for the economy and what that means for the growth path.
Zach, do you believe that we've made enough progress on inflation to put more weight on the other side of the dual mandate and focus on protecting the labor market?
I think we have, John, and I think that's what you're seeing in the minutes last week, going through just what Fed participants were talking about. The emphasis seems to be on shifting toward the labor market. That's not to say that they're not going to remain acutely focused on inflation, but I think the labor market gets a bigger weighting going forward, and we are looking for more normalization there. And to us, with a slowing growth story driven by the consumer in the second half of this year, we don't think they're going to go in July, but we agree that the conversation should begin, and we're expecting the first cut in September.
Zach, when you talk about some of the split screen that we're seeing right now in the economy, where you have certain segments that are doing very well and inflation is still a concern in those segments, I'm thinking of hotel rooms and some particular routes on airlines. On the other hand, you have a lot of places that are struggling, and you see that with the Russell 2000. In the companies that you cover, how much are you seeing real distress starting to pick up in certain companies, even as the overall picture looks stable?
We're not seeing a ton of distress, I'd say, right now, Lisa. What we're seeing is signs that the consumer is slowing down, and we're starting to see a reaction by some of these consumer goods and retail companies, not necessarily taking prices down, but doing more promotional pricing. And I think there's going to be a mismatch in timing of when that shows up in the inflation data and when it's actually taking place in the real economy and how these companies are responding to a slowing consumer. And so when we think about how that changes the balance of risks, we think that fundamentals are going to become a bigger part of the picture in terms of credit spreads in the second half of this year and first half of 2025. And that's why we have a little bit more of a widening bias versus our more bullish view that we've held for really the past 18 months or so.
Rubeela, what do you make of that, especially given that it's so bifurcated, right? I mean, you could have, for example, we're going to be getting the one-year inflation expectations from the New York Fed today at 11. We get NFIB small business optimism tomorrow. These are sort of peripheral measures that have been a little bit out of sync with the rest of everything that's going on. How much do you pay attention to that at a time where you see such dominance of particularly high-income companies and individuals fueling specific sectors of the economy?
No, I mean, it's a very important point, right? I mean, you are seeing a bifurcation. There is, a split, if you look at what high-end consumers are doing versus what, people at the bottom end of the income scale. But, if you look cumulatively, the sign is still the same. The consumer side of the economy is decelerating. We're not seeing a weakening. We're not seeing a contraction. But this is what drives the economy. And we are seeing a deceleration. What's really important is that the services side of the economy, right? That is now moderating. That is something that we have been looking for a while. And notwithstanding, what we're seeing with airline travel and, things like that, but there is a deceleration. Even if we don't, our base case remains that the combined message is that the economy is slowing, the inflation is on a decelerating path, the labor market is loosening, and those things are going to be what drives the policy path forward. And to us, that means that the Fed has to make the policy stance less restrictive sooner rather than later, managing the risk between the labor market loosening versus the labor market weakening. That is a very tricky thing, and I think the Fed is very sensitive to that. There are a lot of uncertainties. You've been discussing this, in terms of the political arena, in terms of the policy arena. Right now, the Fed has to focus on what we're seeing in the economy. And, we think that means that the Fed has to consider changing the policy stance.
Rubeela, I want to ask you a question John brought up earlier. Is this a welcome cooling you just outlined or an unwelcome deterioration?
I think it is a welcome cooling, but like I said, managing the risk between a welcome cooling and a weakening and a contraction in payrolls and a surge in the unemployment rate, that's very difficult. Chair Powell has talked about this. What they're talking about is an unexpected weakening in the labor market. So they do expect the labor market to rebalance more completely. It's just that unexpected weakening is what they're going to be ready to respond to. We're not really seeing an unexpected weakening. We are seeing a cooling, but it still, in our view, justifies making that policy rate less restrictive.
Zach, that's the stance the Federal Reserve is taking. When you speak to people about the unemployment rate, particularly in the market, I'm talking about strategists and investors specifically, they're focused on whether we trigger the SARM rule. I want to know from your perspective, Zach, and we touched on this earlier in the programme, if next month we go to, say, 4.2% on the unemployment rate or even higher, and that rule gets triggered, do you think that would trigger a broad sell-off in this market?
I think we'd have to see at least somewhat of a repricing of risk. And that's really what we're looking for, John, is this repricing of credit risk. We have spreads that are really tight, equities that are really high. And when we think about the balance of risk going forward, we're almost more concerned with that unwelcome deterioration outcome, with the Fed having held policy quite restrictive in our view. And I think there's a lot of uncertainty there, but we do think it's at a restrictive point. And if they don't start to respond to what we're seeing in the consumer, in the economy broadly, then we have a higher risk of that hard landing scenario that everyone was so fearful of in 2023, emerging perhaps in the second half of this year or first half of 2025. So we are expecting that if we do see more deterioration, perhaps at a faster pace than what we've seen so far, you're going to see that reflected in asset prices.
Hey, Zach, good to hear from you. Zach Griffiths there of CreditSights. And Rubeela Farooqi of the High Frequency Economics, as the line between welcome cooling and unwelcome deterioration gets like that thin, Lisa, over the last week or so.
It feels like dancing on the head of a pin. I got that expression right. And I will say that I think that right now people threading a needle, there are other expressions that people are saying that I actually can relate to.
Got that one right, too.
Yeah. Well, some of the others I don't really understand.
Crosswinds under the current. But that's because that's not an expression.
That's why I was Googling it. Well, it's like beating a dead horse with a drum. I mean, it's sort of like I just didn't really, if I don't deeply relate, moving on. Sure. I do think that it is a narrow landing path. And I think that that's the concern for a lot of people, is that it feels like there is a cooling and it just is hard to characterize where we're at.
You're having quite a day. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Paramount shares pre-market up 2.7%. Finally agreed to merge with Skydance Media, and that hands control of the Hollywood studio to producer David Ellison. It also ends one of the industry's most dramatic acquisitions. Paramount chair Sherry Redstone agreed to sell her family's National Amusements. It controls about 77% of the voting stock in Paramount for $2.4 billion. Thousands of workers at Samsung Electronics walked off the job Monday to stage a rally demanding better pay. It's the biggest organized labor action in the South Korean company's half-century history. Negotiations over pay and vacation time collapsed last month. The strike is intended to drive home their demands by disrupting production at one of the company's most advanced chip facilities, according to union leaders. And Despicable Me 4 was the big winner at the holiday weekend box office. The latest movie in the Minion franchise made an estimated $123 million in domestic ticket sales since opening on Wednesday. That according to box office tracker ComScore. Meanwhile, Disney's Inside Out 2 continued its strong run, surpassing $1.2 billion globally since it opened last month. And that's your brief. John.
Danny, thanks for this morning. Appreciate it. Up next on the program, setting you up for a really busy week ahead from New York City. Live from our global headquarters, you're watching Bloomberg Surveillance. 40 minutes away from the opening bow, the cash open just around the corner. Equity futures on the S&P 500 just about positive by 0.1%, coming off the back of an all-time high, a record high to start the week. And what a way to start the week with a brand new show making its debut on Bloomberg TV, Open Interest, with Katie Greifeld, Sonali Basak, and our very own Matt Miller. Katie joins us now for more. Katie, good morning.
Good morning.
What's coming up this hour?
So in the next hour, you're well familiar with the 9 a.m. hour. It's going to be fast, it's going to be fun, and it's going to be a focus on single stocks. We really want to basically tell the macro stories that we talk about all the time through the micro, and what that means basically, you're going to see more single stock analysts, you're going to see a lot more CEOs, hopefully.
How much is this going to be difficult to get people interested in other than the Mag 7, given the fact that there's sort of been this hope and dream the 493 could shake off the gloom and see their own day in the sun?
Well, that's the thing, right? You've actually seen a lot of drama in the sell-side community with Piper Sandler just coming out and saying that they're backing away from S&P 500 targets. I know you spoke to Mike Wilson over at Morgan Stanley back in April saying that he was staying away from those big, bold calls. He actually joins us right at 9, so we're going to basically talk about that. How do you forecast in the age of that super concentration that you're seeing at the benchmark level?
What do you do after the 9 o'clock? The market's open. What's the discussion going to be like with the three of you?
Hopefully we take a big breath and we get into some of those meatier conversations coming up in our 10 a.m. hour. I know Matt Miller is super psyched because we have Stefan Winkelmann. He is the CEO of Lamborghini, and that's really just a read basically on the ultimate luxury asset. And of course, EVs, which they've taken themselves out of the race. They're not trying to make an EV supercar here.
That is the most Matt Miller thing ever, to start a new program on the markets, but managing to squeeze in the Lamborghini CEO. You thought the same thing?
So more cars for the next 3 hours.
Looking forward to the program.
I think we're going to interview every single car CEO. I think that is his stated goal. So.
I have no doubt about it. That show kicking off in about 7 minutes' time. The brilliant Katie Greifeld and the team leading Bloomberg's Open Interest, starting at 9 p.m. Eastern Time, or rather 9 a.m. Eastern Time. Counting you down to the opening bell in about 36 minutes' time. Here's the trading diary for the week ahead. Tuesday, day one of Fed Chair Jay Powell on Capitol Hill. Treasury Secretary Janet Yellen also testifying, plus the NATO summit begins on Wednesday. Fed speak from Goolsbee, Bauman and Cook. Thursday, we'll get US CPI, another round of jobless claims and Delta earnings. Lisa squeezed that in. Friday, PPI and new Mitch sentiment, plus the big ones. It's JP Morgan, Wells Fargo, Lisa and Citi reporting earnings too.
I actually wonder how much the banks are really going to lead the charge. If they sort of signal this weakness ahead in the consumer, whether that could actually get more attention, a disproportionate amount of attention, just based on the balance of risks. CPI seems like it's important, but less so, given what some of the data has been that's been coming out.
It's the politics for me this week. It is a critical week for Biden. It's almost a crisis it is a crisis of their own making, and it's another threshold he needs to clear, a hurdle he needs to clear on Thursday when he comes out and speaks to the press. A press that feels at moments gaslit about how this administration, how members of his team talked about the president and his health.
We keep saying it's another hurdle he has to clear. Do you think there's anything he can do anytime soon that can take away what took place 2 Thursdays ago? Because I think a lot of people conclude the answer to that question is no.
No, but it can become worse. It can become worse if the president comes out Thursday and has a pretty disastrous performance. And then there's these 9 lawmakers now start to spill over to dozens and dozens.
Some people say it was worse that he didn't totally bomb on Friday night because it leaves the Democratic Party in limbo. There's a real question about the time ticking. And at what point does it become basically you're out of time to create another candidate, but there's been a loss of confidence in President Biden. That's the fear under the hood for the Democratic Party right now.
Let's see where we are this time tomorrow morning in the next 24 hours, because a lot can change every single hour in Washington, D.C. at the moment as Congress gets back to work. Coming up tomorrow to run through some of these issues, we'll catch up with George Concavas of MUFG. We'll speak to JP Morgan's Kelsey Barrow. Wei Lee's back on a programme from BlackRock. That's very cool. And Emily Rowland of John Hancock. That and a whole lot more coming up tomorrow. From New York City this morning, good morning to you all. The opening bell about 35 minutes away. This was Bloomberg Surveillance.